were impacted. Divisions including ESPN and theme parks weren't involved in this round of cuts. Meanwhile, oil prices are falling for a second day, with Saudi Arabia reported to be lining up an increase in output later this year. Brent prices are down about 5% from Tuesday's close, and as you can see, WTI is now below the $70 mark. The Financial Times reported that Saudi Arabia is ready to abandon its unofficial oil price target of $100 a barrel in a bid to regain market share. Separately, factions in Libya have reached a deal that could open the way to the return of some crude production in the country. And Hurricane Helene is strengthening as it approaches the Florida Gulf Coast. It's expected to become a Category 4 storm before it makes landfall in the U.S. this evening. Several counties along the coast are already under evacuation orders as the National Hurricane Center warns the storm currently poses a, quote, life-threatening situation. That's your Bloomberg Brief. John?
Yahara, appreciate the update there. Thank you. Up next on the program, economic policy taking center stage.
I'm imposing tariffs on your competition from foreign countries, all these foreign countries that have ripped us off.
I know the power of American innovation, and I believe companies need to play by the rules.
That conversation up next, live from New York City this morning. Good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Equity futures on the S&P, a real lift, up by 0.8% on the S&P 500. A rally in Europe, a pickup in China-related names. The rip-roaring China story, Lisa, continues.
Yeah, and for good reason. I mean, basically, you have a Politburo that is now opening the door to fiscal stimulus, which is a door that they hadn't opened before. A series of rate cuts, getting warmer. Is this going to be the bazooka? And that's basically what people are discussing today.
Not spilling over to the U.S. bond market. Yields are a little bit lower. We're down a basis point or two. The 10-year, let's call it 3.77. Under surveillance this morning, economic policy taking center stage.
I'm imposing tariffs on your competition from foreign countries, all these foreign countries that have ripped us off. Your companies are going to come in, they're going to pay a low tax rate and a really low tax rate if they make their product in America.
I believe in consistent and transparent rules of the road to create a stable business environment. And I believe companies need to play by the rules.
Here's the latest. Donald Trump and Kamala Harris detailing their plans for the economy at campaign events in the swing states of Pennsylvania and North Carolina. Douglas Redeker of International Capital Strategies writing, neither party is fully explaining how to pay for their plans. There are no responsible fiscal hawks this year. Both plans increase the national debt over the next several decades, but Trump much more, almost twice as much. Doug joins us now for more. Doug, good morning.
Morning.
Music to Lisa's ears. Let's talk about it. Do we need responsible deficit hawks?
We do, but it's an election year. So in the context of an election, the idea is to win. And I think both candidates understand that. So we'll get to the fiscal responsibility part later. Right now, they're both making promises that I think anyone who has any kind of bond market focus and long-term, deficit concern is probably not sleeping well at night. But this is an election year.
Doug, how different are their policy proposals? Because a lot of things they talk about are one and the same when it comes to the child tax credit, when it comes to things like no tax on tip, when it comes to things about ratcheting back some red tape, less regulation so American companies can start producing more in the United States. There's a lot of overlap between these two campaigns.
Well, I'd take it a step back. I'd say the old days where industrial policy was a bad set of words and free trade was the norm, those are gone. So now we're at different gradations of how the government plays a central role in the economy. And you're right that in that context, both of them have drifted towards industrial policy and a central role for the government. But I think it diverges from there. I think Trump's view is, very much backward looking. He wants America the way it was in the 1950s and 60s. America was the dominant superpower. We had an industrial base, a manufacturing economy, but we are living in the 21st century. So even though she is embracing some of these policies that are more government-centric, that are more spend, let's not worry about how we're going to pay for it until later, I don't think that the specifics overlap all that much. Her embrace of tariffs, for example, which was very muted in her policy plan yesterday, is a very different animal than Trump's. Trump believes that tariffs are the silver bullet. They will solve everything. Geopolitically, economically, financially. I mean, that's just, give me a problem that a tariff will solve it. She's more targeted. She's more measured. She's more forward-looking. I'm not saying that I agree with every word in her 82 pages yesterday, but it certainly was more well thought out than his more across the board, throw it against the wall and see what sticks.
You're here for meetings alongside the UN General Assembly, but you talk to everyone in Washington. Is there a party that if you're a free trade capitalist, you can belong to anymore?
No. I mean, the sad answer is the Jack Kemp, Paul Ryan, even Mitt Romney Republican Party doesn't exist. Now, I think there's a hope amongst many centrists and many Republicans that if Trump loses, and if he loses in such a way that he somehow goes away, that the Republican Party is not going to revert back to the old days, the country club Republicans who believed in free trade, but that there would be a resurgence of that business-friendly, market-friendly mindset where trade is not a bad word. I'm not sure that's going to happen anytime soon, but I think that's the broad hope.
Lisa brought this up earlier, and it's a really good point when it comes to U.S. Steel and Nippon Steel. Something Kamala Harris said yesterday was basically she's more in the Jake Sullivan camp than the Janet Yellen camp, which is national security matters more maybe than jobs. What is the direction of travel for either of these two candidates when it comes to, say you're a foreign company and you're from an allied country and you want to do business in the United States?
Yeah, so I think both parties, both candidates, understandably have put a premium on national security over pure commercial interests. I think that's probably the mindset we have to get used to. The Nippon Steel deal is a little more problematic because the national security justification is at best a stretch. But I do think the Japanese and most corporates around the world in Japan and elsewhere understand this is in the context of Pennsylvania being if not the most important state in the election, and the general atmospherics around this election. So I'm not looking at that as Kamala Harris has now decided that even allies like Japan are not worthy of making foreign investments into this country because they are a national security risk. I think it's more of a unique circumstance.
Let's build on this idea of understanding what the framework is currently to measure national security versus sort of capitalistic business interests and jobs. Do we have a sense of some sort of predictable framework to determine that exact evaluation?
You actually want me to define small garden, high fence? I mean, we don't know how high the fence is. We don't know what's in, what's out. It's an expanding, flexible concept, and national security isn't something you can quantify. So I think that there are some judgment calls that are baked into it. But you're right in questioning just how far down the road this government or the next government can go, and what certainty investors are going to have in that context.
Well, just to take this a step further, if I'm a company and I want to do a takeover, or I want to do a deal, or I want to know where to source my materials, how do I know when that's going to enter the crosshairs of national security? When there could be materials, it could be chips, it could be our food chain, it could be anything. And you know, we saw that with respect to some of the supply chain questions having to do with with a conflict in the Middle East. How do we understand when that cross?
National security issues are often ones that are subject to confidential sources, confidential information. There's a lot of reasons why these things do not want to be on the front pages, and so I'm a little bit upset over the CFIUS process playing out the way it has, even as much as the underlying question of how you define national security.
What Lisa's getting at, though, I think is important, Doug. It's been difficult under this administration, who have appeared to use national security as a pretense, a sophisticated way of basically just exploring the same protectionist bend that the former president used. So it's really hard for me to understand what is really a national security issue. What really is just about a sophisticated excuse to do the same thing the former president was doing without saying, we're like him, to sit here and say, we're different.
To some degree, the problem is the Nippon Steel deal, because that is the one in which there's a lot of reasons to believe that they are stretching the national security definition. But I would also argue that dual use in the current context, whether it is what we've seen in Russia, Ukraine, or what we've seen in China, means that dual use, so those items that are commercial but can also be used for military purposes, is an expanding definition. So there's a legitimate case to be made that things that were not national security threats a decade ago are national security threats now. If you've got a dishwasher that has a chip that finds its way into a Russian drone, then, you know, you would say, why are you calling a dishwasher a national security threat? And actually, it turns out it is.
Doug, smart, as always. It's good to see you. Let's do it again soon. Douglas Redeker of International Capital Strategies. Up next on the program, Barbara Humpton, the CEO of Siemens, on the build-out to power AI.
This spirit of we'll figure it out is my favorite thing to hear among early startup team members. a lot of things go wrong. The situations that startups win in tend to be incredibly dynamic. And so this idea that even if I'm not qualified on paper, even if I haven't solved this problem before, even if this problem feels like it's going to kill the company, which many problems will feel that way, this spirit among the team of, you know what, we've got the people we need, we're going to figure this out, we're going to get this done, that's super important. Another thing that I love to hear from early team members is, I've got it. So, you know, you hear in big companies a lot, people say, that's not my department, someone else is going to do that, or, you know, ooh, this is really bad, this is going to hurt us. And you want people who just step up and say, I'll do it, I've got it, don't worry about it. You want people that have a bias towards action. Startups, especially in their early days, often win by moving very quickly. You never get as much data as you'd like. You never have as much time to deliberate as you'd like. And you want people who are willing to act with much less data than they like to have, with much less certainty. And then if they act and it doesn't work, they adapt really quickly and try something else. We talk also about the blessing of inexperience. We have seen many of our startups do incredible things because no one told them it was hard, or no one told them they can't do it. There's a great quote from Steve Wozniak about how all the best things he ever did came from having no experience whatsoever and having no money. And, you know, that obviously is not always true, but there is a magic thing that happens with startups, especially in their early days, before they've learned they're not supposed to be able to do certain things. And so I think as a startup, again, it doesn't work to have everybody be inexperienced, but you can take more bets than you normally would on inexperienced but super high potential people. That's the end of the topic on team. One of the most important jobs you have as a founder is to never lose momentum. And this is a little bit depressing because it means for the first few years, you never get to take your foot off the gas. You never get to really rest. We try to be honest about this, that startups are not the best choice for work-life balance at all, but especially in the early days. Startups survive on their own momentum. If you have momentum, people keep delivering results beyond what they think they're capable of. If you lose momentum, it's very difficult to get it back. And so continuing to make sure that the startup has a cadence, that the startup keeps winning on a relatively short and predictable intervals, this is really important, and it's up to the founders to make sure that you don't lose a hold of this. Another thing that we think startups need is a competitive advantage over time. Now, this is something that sounds so obvious, I hesitated to even put it in. This is well discussed, but we're seeing more and more startups apply to YC, and when we ask them, so what is the long-term monopoly effect here? What is the long-term competitive advantage? What is, you know, where is the network effect in this business? They look at us like it's the first time they've ever heard this question. All of the really great businesses I know have an answer to this question. And in fact, the better they are, the more they pretend not to. But this is something that you want to have a plan for. Another thing you want to have a plan for is at least a sensible business model. You don't have to have it all figured out at the beginning. But when we ask founders, so how are you ever going to make money? And they look at us like it's the first time they've ever been asked that question, which happens more often than you would think recently. That's a bad sign too.
Producing more than 13 million barrels a day. So now what they're going to do, they're going to go after market share, and they're going to be the best at this. And that means prices are likely going to be coming down.
Well, let's talk about the bond market then. Let's get to that story. Yields are lower. I just wonder if treasuries are speaking to what Anne-Marie's talking about more than what we're talking about with regards to China.
The fact that you end up with some sort of disinflation from a price war having to do with oil, a supply side driven decline in oil prices that just helps this, you know, soft landing nirvana that we're talking about. At a certain point, you have to wonder, has the threshold just gotten lower and lower for the Fed to be more aggressive in their rate cuts? And how much do we hear that tone from all of the Fed officials who are lined up to speak today?
That move in the commodity market would certainly help. We've also got an auction later, I'm told, $44 billion of 7-year notes at 1 p.m. Eastern time.
7-year notes tend to be a little hairy, so this could be interesting, but we haven't had that many interesting auctions recently, so I don't want to get too hyped, but it could be.
No midday nap this afternoon.
Never.
Tune in. Under surveillance this morning. A top story here here in New York City, some breaking news for you. The New York City Mayor, Eric Adams, has been indicted following a federal corruption probe. Sources telling us here at Bloomberg it's not yet clear what the charges are. The indictment is expected to be unsealed later on today. Adams vowing to fight the charges and stay in office.
And 6 a.m. this morning, with the New York Times is reporting that federal agents are actually searching Gracie Mansion. Here's a little bit of what the New York Times is saying. A group of roughly a dozen men and women in business attire arrived outside the entrance to Gracie Mansion SUVs, at least one of which had a place card talking about the federal law enforcement, that they're law enforcement. They carried briefcases, backpacks, duffel bag, and maybe even one appeared to be a camera bag. So this is going to unfold very quickly as we wait for that indictment to be unsealed.
All the scriptwriters out there who've been on strike and waiting to create some things, there have been some real stories recently that they can tap into. This is one of them. What I find interesting, this is about potentially pay to play, particularly from the Turkish government, and questions around that. The potential support or lack thereof that this mayor has from other Democratic officials. We talked about that earlier. This from Scott Stringer, the Manhattan Borough president and mayoral candidate. His fight is not our fight, and I think that that's the tone that you've heard pretty much across the Democratic Party.
You've made this point a couple of times. It's not what we've heard, it's what we've not heard. Very little support coming from this party.
Which means that the path of least resistance, how much is it for him to step down, which is what a lot of people are calling for. And then what's next? And we get to discuss that for another day.
You excited for that?
You know, I actually am, just because I'm personally biased. I actually care about this city. I grew up here.
Most people that live here do.
You know, I want to see it do well and be safe and be clean and have good schools.
You're running?
I don't know. Just wait. Maybe let's see how the bond auction does.
Lisa's thinking about it. Let's turn to this story. Lebanon's economy minister telling Bloomberg that Hezbollah has shown flexibility regarding a proposal for a ceasefire with Israel. Meanwhile, Israeli Prime Minister Benjamin Netanyahu's office saying the news about a ceasefire is incorrect and that the IDF will continue fighting with full force.
Well, the administration is saying that we should expect a statement from Israel, from Lebanon, that they would agree to this short-term ceasefire. Netanyahu doesn't seem to be on board with that. He is going to be speaking at the UN. He is arriving in New York today, and his speech really has taken on utmost importance now. I question what the administration plans to do. Tony Blinken is here in New York trying to work out a ceasefire agreement between Gaza. That has taken them about a year. And guess what? They have nothing to show for yet. So now they want to do diplomacy when it comes to Lebanon. Meanwhile, Israel is preparing for boots on the ground.
Want to watch the UN a little bit later. Just to combine these two stories, we had a friend message us yesterday who said that he would run for mayor and the first policy would be to move the UN. And that perhaps all New York City people would vote for that.
He was speaking to the choir. I know you've mentioned it. I'm getting some notes saying that I should not run. So.
Is that a platform to run on? Who's telling you not to run?
I think that is a platform to run on.
They just want to hear about the bond auctions,
So long as you do the show.
Yeah, then, you know, can you imagine?
Do what you want.
From Gracie Mansion.
You go to Zero Bond in the afternoon.
Yeah.
Whenever that opens.
Don't worry, I will.
Never been, don't know what time it opens, but, you know, apparently that's a thing now.
They now have a rooftop, so.
They don't have a rooftop?
No, they now have a rooftop.
Oh, they now have a rooftop. That's good to know. Okay. You know, plenty to do.
Yeah, but I don't know about the UN.
Okay.
I kind of like the stamps.
You like the what?
Stamps. You can buy your own stamps that are separate for the UN because it's actually its own kind of domicile. So that
Didn't know that.
Yeah, so it's basically another country. It's not actually part of New York. It's its own thing.
Very cool.
Yeah.
Like the Vatican.
Yeah, exactly.
But not quite.
Carry on.
Thanks. Kamala Harris saying maintaining domestic control of U.S. steel is more important than potential job losses from the proposed takeover by Japan's Nippon Steel. This as Nippon says it's talking with the United Steelworkers in a bid to build support for its $14.1 billion deal. You picked up on this line. I think it's a really important one.
The idea that potentially there could be this trade-off and jobs could be sacrificed, but national security trumps it. There is a bigger question here, which is, do we have a sense of what national security concerns are, what that trigger is that would create a preeminence of that as being the consideration over jobs, over some economic concerns? I don't have a sense of that. And honestly, Doug Redeker was trying to give a sense, well, yeah, you're not going to get that, and it should probably be secret. But could it be abused then for personal issues or for potential specific political causes?
Well, we do know that under this CFIUS agreement, as these agencies come together, there's not an agreement right now, which is why they have these 90 days. The clock restarted for Nippon to basically bring their case forward. The question I have is whether or not CFIUS comes out with a review and puts it on Biden's desk before November 5th, because Biden said that he would veto that. And is that enough to potentially shore up some of those votes in those counties she needs in Pennsylvania?
This is becoming a bigger and bigger case study of how not to do it. becoming a political football on a campaign trail right up through November and beyond.
Yeah, and how it got into the public eye, too, I think is going to be an increasing question.
Let's turn to this story. The growing demand to power AI, forcing big tech to look for alternatives. Bloomberg Intelligence estimates Microsoft will pay Constellation Energy at least $100 per megawatt hour once the 3 Mile Island nuclear plant restarts. Siemens USA is also looking to build out energy infrastructure in the face of new demands. The CEO, Barbara Humpton, joins us now for more. Barbara, it's good to see you.
Jonathan, great to be with you.
Let's start with the big picture, the energy trilemma: security, sustainability, affordability. Can we square that circle, that triangle? Can we address that issue?
Well, we have to. I mean, the bottom line is the economy can only grow as fast as the grid. We need power for everything we're attempting to do as a nation right now. And so we have to find more sources of power. At the same time, we've got to attend to the security. And of course, affordability is a big issue. That's why Siemens is working on bringing technology into the mix. Maybe we're going to take longer than we like to bring new sources of power onto the grid, but we can use software and technology tools in order to manage the electrons we produce more effectively.
Talk to us about the technology solutions. We hear all these things about off-grid solutions, microgrids. What are the kind of things that you're working with?
Yeah, this is really exciting. I've been sharing with a lot of colleagues that the grid edge may be the most exciting place to be in the economy right now. Think about all the buildings with all their electrical products. Think about the ability to now put solar on buildings. We've got batteries in cars, so we have many, many more components capable of storing or producing energy. Now we network all those together with software, with the grid components that create microgrids, giving us the ability to maybe separate parts of the grid for security reasons if we've got, say, weather disruptions like we're expecting right now all across the country. So Siemens has been working for a long time. Most recently, you would have seen coverage of our Bronzeville project with ComEd, where we provided a microgrid to the neighborhood of Bronzeville, which integrates storage, power production, and produced enough excess energy that the utility was able to offer the community an electric vehicle so that people could make it to their doctor's appointments.
The demand is there. Companies are willing to pay for it. Evidence Microsoft just a moment ago. It raises a question: how much do we have the capacity to produce it in short order, the goods necessary?
Pardon me, which goods are we talking about, Lisa?
Just in general, whether it is having to do with the chips, whether it has to do with the electrical grid wiring, whatever it has to do, the infrastructure necessary to make what you're talking about.
This is exactly why Siemens has been investing in the U.S. Over the last year, we invested $500 million. One of the huge things was to open up new manufacturing in Texas for the electrical switchgear that will go into data centers and actually help at the grid edge. You'll be seeing an exciting announcement a little later on today, and I'd encourage everybody to be on the lookout for it in North Carolina as we continue to expand operations.
How much is the end user and the end buyer government agencies or government regulated agencies versus big companies like Microsoft?
Right now, the hyperscalers obviously are at this. And as I move across the country, I would tell you that if it were not for restrictions on the grid, the appetite for building AI data centers is unlimited. But we all know that we're going to be actually limited by the amount of power that can be produced. So those hyperscalers are moving all around the country looking for where can they get gigawatts of power.
And the best places for gigawatts of power sound like they're in the South, North Carolina, Texas.
Often, but this is where we're making the switchgear, but you're seeing data centers pop up everywhere. So can you find an asset that's underutilized that can produce power? Put a data center close to it and make that local use of power very efficient. And so we're seeing all forms of energy actually coming back on the grid.
The demand is definitely there in the United States. The Biden administration has been backing this with the Inflation Reduction Act, but I still hear complaints about permitting and red tape and how hard it is to build something even like a transmission line. Do you come across those same problems?
This is the issue in our world. Siemens is in the backbone of the economy, and so we're working hard on making sure that we do address the growth of the grid, for instance, the growth of manufacturing. Permitting is key to being able to get us to move quickly. In the meantime, what we're encouraging people to do is everything they can behind the meter. Anything we can do to save energy means we have more energy to deploy for new growth. So get behind the meter, start doing energy conservation measures, but then likewise start implementing the kind of solutions that allow us to use our energy wisely.
Can we talk about the EV charging business? Independent unit, independent business. Why go in that direction with it?
Yeah, you know, EV charging is a really critical business for the world right now, and Siemens has the know-how to create chargers. You know that we had committed to build 1 million EV chargers, and we recently actually acquired Heliox to be able to be in the DC, charging infrastructure and be able to really address large fleets. Proud to say the Postal Service selected us as, for instance, as one of their providers for charging technology. When you look at that, it is capital intensive. And so the big question is, how do you set them up for success? And our expectation is that by taking this kind of action, we actually give them the ability to control how they're going to raise the resources they need and give
Update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira Hackers. Hey, Yahira.
Hi, John. The U.S. is sending additional aid to Ukraine. The Biden administration announced a new weapons package worth $375 million. Ukrainian President Volodymyr Zelensky is expected to present President Joe Biden with his victory plan today, which will include a pathway to NATO membership. The Associated Press is reporting that billions more in aid will be announced later today as well. Meanwhile, Commerzbank out with a new pledge to investors. The German lender vowing to boost profitability to $4 billion by 2027 and increase shareholder returns. The bank trying to boost investor support as it gears up for a potential takeover by Italian rival UniCredit. The incoming Commerzbank CEO Bettina Orlopp is expected to meet with UniCredit Friday. And OpenAI is discussing giving CEO Sam Altman a 7% equity stake in the company, marking the first time Altman is granted ownership in the AI startup. It's also discussing restructuring the AI leader to become a for-profit business. OpenAI is considering these changes against the backdrop of an exodus of senior managers, including Chief Technology Officer Mira Murati. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the program, the Fed giving markets the all clear.
Powell is not going to let this economy have any kind of a hard landing, and so the market is just off to the races. It looks like if the economic data continues the way it is, they will do probably 25 in November, 25 in December.
So what do you do if you're sitting in cash? Jerome Snyder at PIMCO, up next.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Or other authorities.
Could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg loves earning.
earnings. I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Equities right now up by 0.75% on the S&P 500. In the bond market, yields a little bit lower through most of this morning. We're down a basis point or two, 376.58. Under surveillance this morning, the Fed giving markets the all clear.
Powell is not going to let this economy have any kind of a hard landing, and so the market is just off to the races. It looks like if the economic data continues the way it is, they will do probably 25 in November, 25 in December. I don't think they should be making these big cuts all right at the beginning. Let it work through a little bit, see where we stand.
Fresh economic data just around the corner. Jobless claims at 8:30 Eastern Time, and a busy slate of Fed speak also on deck, including comments from Fed Chair Jay Powell. Jerome Schneider at PIMCO writing, the outlook for the U.S. remains solid, with growth still suggesting remote probabilities of a hard landing. Market pricing suggests a neutral rate of less than 3% will be achieved by the end of next year, something at odds with current data and PIMCO's outlook. Jerome's with us now for more. Jerome, it's good to see you.
Good morning to you.
Let's compare and contrast that with your outlook then. What's your outlook?
So ultimately what we have is all the Fed speak that's going on. And unfortunately what we're finding is that the market remains more data dependent than the Federal Reserve at this point in time, reacting to individual discrete points of inflation and clearly growth in unemployment. Ultimately, that's going to be reconciled. But when we look at the survey of the landscape, Fed officials are going to be thinking about what's the proper unemployment rate that they are comfortable with. Is that necessarily a linear trajectory? It probably isn't. And over that point in time, ultimately, what is the neutral rate that you have to get to, which facilitates a balanced economy? Now, there's a lot of conflict in that right now. The Federal Reserve thinks that's somewhere between 3 and 3.5%, something in line with what PIMCO believes, but yet the market suggests it's somewhere around 2.75%. So that neutral rate actually is very divergent from that, and almost suggesting that the economy, or that the market right now is looking at a recessionary or hard landing for the economy. That's the construct of what we're dealing with right now. So market is interpreting, risk assets are interpreting that the put, if you will, risk assets are going to be supported in the near term and longer term by the Federal Reserve, when in actuality, that road may not necessarily be as smooth as participants might encounter.
So how do you think we'll resolve our differences?
So ultimately, you're going to resolve your differences by rationalizing where growth is, how the economy develops. Admittedly, consumerism is very strong right now. You're going to see a third quarter consumer print about 3.5%, third quarter GDP. It's very sustainable at this point in time. And even PCEs over the next day or so when they're released are going to be slightly stronger than expected. That doesn't necessarily mean the economy is rolling over in the near term and may not necessarily elicit the function from the Federal Reserve that people think in the near term. Now, that doesn't mean you don't get to R-star. You eventually will, and so there are rate cuts. And so we have to be careful as practitioners at PIMCO, but also as individual investors, to think about how that evolves. And that doesn't mean that you should be reacting to every single maneuvering in the front end of the market. And to your note, we're not all Fed funds traders. We shouldn't be. We should look instead at the potential for price appreciation that is derived from Fed yields moving lower and prices moving higher. That's what's interesting out there right now at this point in time.
So put all this together, and basically you're saying maybe the Fed's not going to cut rates as quickly as people think, just because the consumer is doing what the consumer does in America. It's going out and spending, and it doesn't really impose some sort of recession on us. And then you write this: it's time to bail on bills. Yeah. If I were listening to you, there's a lot of risk out there, and price to perfection, et cetera, that people talk about. Why shouldn't I be in bills then if the rates aren't going down so quickly and, it kind of feels good?
Listen, our job was tough at PIMCO for many years, zero rates. And then it became tougher for people in my sector that had the easy route of buying bills at 5% yield. That was the right trade for 2023 and the beginning of 2024. But what T-bills don't do at this point in time is have price appreciation. There's never a T-bill which has garnered price appreciation along the way. And fixed income works in a variety of ways. One, it's income. Clearly, that's a very different landscape than it was a few years ago. But the second component is use the tailwind of the Federal Reserve moving rates lower to have price appreciation within your fixed income construct. More importantly, it's a lower volatility type of implementation within your portfolio.
Are you basically saying, forget T-bills,
Right.
go to 1 year to your corporate notes or something like that that gets a price
Have a
appreciation?
more diversified portfolio. Here's one thing that's really interesting. When you look at a money market fund, when you look at T-bills, we've already seen that recalibration. We've already seen T-bill yields move lower by 40 to 50 basis points overnight based upon the Federal Reserve. We've already seen money market funds evaporate. The headline yield on a money market fund might read 4.8%, but the chances of you getting that return is very remote over the course of next year. It's going to be most likely 3%. So find the balance of having some total return which benefits from the price appreciation in bonds. And to do that, you need to step out of that curve.
How hard is it to give people that message while also saying this is a time to remain liquid, to be nimble?
It's incredibly hard because when you think about the history of utilization of people reacting to changes in the Fed funds benchmark, easing of monetary policy, it takes 12 to 24 months for people to move out of money market funds to do that. People are going to, if that happens, the expectation of where rates are a year from now is 2.75% currently. You're missing out on 200 basis points, 2% of opportunity for your cash. That's the reality of it. So maybe you decide that T-bills aren't worth it, but the reality is it doesn't resonate with people until after the fact. That's why it's so urgent to have people react to not just the daily data that comes out, but also let's take a moment back, breathe, and see what's really happening in the landscape of investing.
I'm taking a deep breath. I have one more question because I'm still confused. Okay, so let's go back to the start of the interview. If you think the market is priced for neutral below your estimates, I'm trying to work out how we reconcile that and get price appreciation in bonds at the same time. Where does that come from as we close that gap? Where's the sweet spot on the curve?
There's a couple things. One, don't be so tactical that you're going to react to every single data point at this point in time. Number two, the starting point for fixed income is positive real returns, meaning you're going to earn a positive after inflation return at this point in time of 1.5% or something in that regard. Fixed income's attractive in that regard. So don't get caught up in the minutia of here, the Fed funds rate is going to be expected to be X today, and it should be really Y. Instead, the gradual move lower of benchmark rates will provide that tailwind of price appreciation. We haven't completed that. That's the key difference, Jonathan. And when we get that, you're going to see bond prices move higher. And when you add layers of diversification through corporate bonds, mortgage securities, things like that, the step out of cash, timing to bail on bills, is incredibly prudent right now.
Got it. Jerome, appreciate it. Clinic, as always, thank you, sir. Jerome Schneider at PIMCO. You up to speed? That felt like a clinic, right? Deep breath.
Yeah, well, it's just
T-bills.
the difference between putting it in a money market and putting it in a managed fund that actually goes into things that have a price that trades. It's sort of the difference.
Big difference. Coming up, Jim Caron of Morgan Stanley, Jakob Stausholm of Rio Tinto, Jay Bryson of Wells Fargo, Kelsey Barrow of JP Morgan, and finally, look out for this one, Jens Stoltenberg, the NATO Secretary General. Stacked third hour of Bloomberg Surveillance, up next.
We want to make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that most households where most of the dollars go against the pet, but treating. And then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today. and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Our principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the U.S. We did that between different parties in Lebanon and Sudan and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the party. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
We need to look at some other areas of the labor market, not just the payroll number.
The slowdown in the labor market would not be a great thing because that tends to not be something that turns very quickly.
I think markets are now laser focused on this job section.
The labor market is balanced. Inflation readings have come down.
I think the biggest risk is not necessarily inflation picking up. That could be part of it, but more of a melt up in markets.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Big hour coming up on this program, 8:30 Eastern Time, jobless claims just around the corner. Going into it, equities, session highs up 0.8% on the S&P 500. On the NASDAQ 100, quite a run. A big pop, up by 1.5%, encouraged by the move with Micron after the close yesterday, but also the latest out of China, just a rip-roaring rally out of Chinese equities once again this morning.
Given the fact that now they're coming out with fiscal stimulus, people were wondering how far they were willing to take this. Right now, it seems like much further than many people had expected. Analysts initially saying, this isn't a bazooka. Next day, this isn't a bazooka. Now, maybe it is a bazooka. We don't know what's coming up next. The key is to understand what the thinking is and why now.
Stronger Chinese currency, copper ripping as well, briefly through 10K for the first time since July. Anne-Marie, copper this morning up 1.75%.
Copper up, as Lisa is talking to, a number of base metals, precious metals going higher. What is going on in China? This is good for the market, except for oil. That is the one place where in the commodity space you really don't see a rise in prices. And why? We potentially are going to have a price war on our hands in just a few months, Jonathan.
Will jobless claims spoil the party? Let's talk about jobless claims. The data drops in 28 minutes' time. The estimate in our survey, 223, the previous number 219. After you get that data point, you have got a ton of Fed speak today, including Chairman Powell and New York Fed President John Williams. Claims it's the big one.
Especially given the fact that everyone just keeps saying that this is a market that hinges entirely on the labor market. Jerome Schneider of PIMCO just said something really interesting. This market is more data dependent than this Federal Reserve. Right now, this market is more hinged to the idea of soft landing nirvana than anything more of a wobble, which could be potentially represented in jobless claims or beyond. That, to me, is the biggest hang up at a time where otherwise it's basically firing guns on all sides. Let's go, let's go, let's go.
When it comes to data dependency, UBS's Paul Donovan puts out a note this morning talking about this increased frequency. Size of data revisions underscores the dangers of being data dependent and in driving policy. So when you get obsessed with the data, how concerning is that when basically in a week or two time you find out there's a lot of revisions?
This is the issue we've all got. You've just got to assume the data's worse than it actually is when it comes in, and that's the bias of this market at the moment as well.
Yeah, which story do you pay attention to? And I think that that's sort of when you start talking about Micron, it comes out better than expected earnings. People are spending, maybe a revival of personal computers and smartphones. On the flip side, I thought it was interesting that Disney is doing another round of corporate layoffs. You see just the idea of efficiency. How do you maintain margins? We were talking yesterday about the paddling duck of corporate earnings to keep margins at a decent price. This was Lisa Coleman from JP Morgan Asset Management. There just is uncertainty from companies in addition to the macro data, and it has been trending lower. You can't discount that at a time where some people are just getting carried away with soft landing nirvana, myself included this morning, because how could you not?
I know, you sound very optimistic. It's almost jarring. You mentioned Lisa Coleman. I've got the quote in front of me. Companies have been working hard to maintain margins by maximizing efficiencies wherever possible. Layoffs have not been and are not anticipated near term to be used. When they are, this story changes.
And when they are, you've already pushed all the levers far enough that it doesn't just end up being a one-time thing. You end up with not a lot more to cut. And that is not a scenario that the Fed wants to get to. Question that we've been asking is, how effective are these rate cuts in actually preventing that versus, if it already is going to happen, it's going to happen, right? But we won't know until it already happens. And I'm talking about a downturn. And that's the reason why jobless claims will be the seminal moment of today.
At the moment, things are so good, even Lisa's bullish. Equities are up by 0.75% on the S&P 500. In the bond market, yields are lower by 2 basis points. The 10-year 376.58. Coming up this hour, Jim Caron of Morgan Stanley on why he's keeping a close eye on the labour market. Jakob Stausholm of Rio Tinto as base metals advance on Chinese stimulus, and NATO Secretary General Jens Stoltenberg as Ukraine pushes for continued Western support. We begin this hour with equities heading back to all-time highs. Investors looking for the next catalyst, including remarks from Fed Chair Jay Powell and jobless claims less than 30 minutes away. Jim Caron at Morgan Stanley has a warning for the bulls. The labour market may be weaker than reported numbers imply. It may mean they want to cut aggressively, but inflation may not allow them to do so. The US may encounter a period of diminished counter-cyclical monetary and fiscal policy tools to buffer future shocks to the economy. Jim joins us now for more. Jim, talk about killing the mood, buddy. How bearish are you based on that quote?
Well, I'm not bearish, believe it or not. I'm actually, somewhat optimistic, and our positioning reflects that. We are, slightly overweight on the equity side. But my concern is about the future, right? How long can this actually continue? And where my concern is that Fed policy, what we call their policy reaction function, is based on a series of data, which is the employment data, which we know has been heavily revised lower consistently. Even the March over March numbers were revised down 840,000, over that 1 year, 12-month period of time. And the Fed is trying to defend a 4.4% unemployment rate. And plus, we have immigration and all the COVID-related uncertainties that are still coming through the marketplace today. So the policy reaction function is really trying to focus on employment data where we don't even really fully have a good grasp of the whole, of the real population of the U.S., a working population of the U.S. due to immigration. I would argue that the data would suggest that the unemployment rate is actually higher than what's being reported right now. And if you look at the confidence number, jobs hard to get versus jobs easy to get, that was one of the key deterioration components. So yes, the labor market is tight today. It's strong today. But the go-forward indicators would suggest that the unemployment rate is likely at a higher level than what we're seeing today, and it's going to be really hard for the Fed to defend a 4.4% unemployment rate.
So, Jim, let's work through this. The risk is the data's worse than we think it is, even worse, 1. 2, we're overestimating our ability to deal with it. So let's talk about what you do in equity markets. You came on at the start of August when everyone was freaking out about that July jobs report, and you said this is an opportunity to buy. Why isn't this an opportunity to sell, given what you've just said?
Yeah, so effectively what we have done is we've taken down our overweight in equities towards a more neutral level. I'd say it's still tilted towards some risk on, so we have taken some of that risk, risk down. The reason why really has to do with margins. So what's happening right now in jobs? Remember, the economy and markets can be very, very different. So what's happening right now in terms of earnings and multiples and cash flows going forward is that labor costs are likely to come down because of everything that I'm saying. Yet the overall economic run rate, GDP might be 3% in the third quarter, is still reasonably good. So you have corporations with their biggest source of cost, which is usually labor, which is starting to come lower, is actually starting to preserve those margins and making those earnings in the future more valuable, and people are willing to pay a higher multiple. So if you look at, for example, consensus 2025 earnings for equities, call it around $280, and you still keep a multiple of 20 or 21 around that, then you're looking at S&P 500 numbers that could go up towards 5,800, 5,900, and possibly even a little bit higher than that. So it's really hard to actually push against that and be very bearish on equities at the moment until, as Lisa was saying, you start to see a real deterioration in the labor market, and then you get loss of consumption, and that could create more layoffs and more decline in margin. But we're not there yet. It's a question of the timing.
Jim, what do you sell? And this is something that people have been grappling with. Which aspects of a market that's broadly thought to be overvalued?
Well, I have an unpopular answer, and what I think that you sell is fixed income. And the reason I say that is that if I look at bond yields, like not short duration bond yields necessarily, but longer duration bond yields out to 10 years, around index duration, say 6 years of duration, I think that bonds have priced in over 250 basis points of rate cuts already. So what we've been selling down, where we've been taking some chips off the table, is in reducing our fixed income. Bond yields came down. We think that they're priced for over 250 basis points of rate cuts. And I don't really think that they're going to go down materially more unless we have a hard landing. We are in the soft landing camp. So the risk could be that you end up with a Fed that might not be able to cut rates as much, yet the bond market, the interest rate markets are already priced in that space. And even in high yield, I mean, we've been overweight high yield all year, and we're thinking now about taking that down just because high yield yields have come down towards around 7%, and there's not much excess return over treasuries once you account for default risk that makes the high yield asset class as attractive as what we had thought. So we're actually reducing some of that interest rate and duration risk and spread risk within fixed income.
Just to put a bow on it, John read this line from your research that I thought was really interesting, that the U.S. may encounter a period of diminished counter-cyclical monetary and fiscal policy tools to buffer future shocks to the economy. You went on to say that this could increase risk premia broadly across assets. Is this more true for treasuries, and are treasuries now considered a risk asset at a time when potentially there are other factors, in addition to inflation, but also the deficit kind of hanging over the profile?
Yeah, I think it's all connected. So effectively, when I say that we could enter a period of reduced fiscal and monetary, countercyclical monetary and fiscal policy, really what I'm highlighting is that, if we look at mortgage rates, people have mortgages, likely already. Cutting rates doesn't necessarily release a lot of spending from the household sector because not as many people are going to refinance. Bond yields are already relatively low, so that's already accounted for. On the fiscal side, the U.S. deficit is between 6 and 7%. I don't care who the next president is, it's going to be really hard to spend money. So the ability to have like an America Rescue Plan if there's a downturn, or the ability to cut corporate tax rates to boost the economy in that sense, is going to be really hard no matter who gets the next job. So what that means is if we put it all together on the monetary side and also on the fiscal side, that it's going to be hard to generate stimulus if we have a bigger downturn. What it also means is that at the margin, bond yields may not go down as much as what we had experienced in the past, few decades, in response to these, kinds of events. So it does put a higher risk. I wouldn't call treasuries a risk asset, but I would say that it does put a higher risk premium on treasuries, and it means that investors need to demand a slightly higher yield these days, and that creates a higher overall yield construct for markets.
Jim, this was really thoughtful. Super thoughtful. Appreciate it as always, sir. Jim Caron there of Morgan Stanley. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahira Hackers. Hey, Yahira.
Hi, John. The New York Times is reporting that early this morning, federal agents raided Gracie Mansion. That's the official residence of New York City Mayor Eric Adams. The search coming after sources told Bloomberg the mayor had been indicted following a corruption investigation. A source says the indictment is likely to be unsealed later today, and the charges against him will be made public. Meanwhile, Southwest Airlines is getting a lift in the pre-market. The company raised its third quarter forecast and announced a new $2.5 billion stock buyback program as part of its turnaround plan. Activist investor Elliott Investment slammed the carrier's recovery strategy as being reckless and chaotic and said it would continue to seek a board overhaul as tensions mount over the airline's future. And the race for the final playoff spots in the National League will have to wait as Hurricane Helene hits the Southeast. The remaining games in the critical series between the Mets and the Braves have been postponed and will be played in a doubleheader next Monday. The Braves currently hold a 1-0 lead in that series. The storm is forecast to strike Florida's Big Bend region as a major hurricane later today. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate it. Up next on the program, the Morning Calls Plus. Rio Tinto CEO Jakob Stausholm as Chinese stimulus sends base metals much higher. That conversation just around the corner. From New York, good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The opening bound 1 hour and 15 minutes away with an equity market lift here on the S&P 500 up by 0.75%. In the bond market, Lisa, yields lower by 2 basis points. Jobless claims just around the corner.
Could it kill the mood where you see yields going lower for the wrong reasons and that sending potentially risk assets lower? And that is, I think, what people are on tenterhooks to find out whether they can actually just lean into soft landing nirvana.
You're not killing the mood. You're sort of on board with this move, aren't you?
I mean, honestly, give me a reason not to be.
I think
you could, I mean, honestly, I think that revisionist history is something that people are pointing to, including Andrew Hollenhorst, who just came out and said, typically you get these downward revisions in a bad time, and just wait until it really comes out. So, you know, I have to temper it.
Everyone messaging their broker, Bramo's bullish, I don't know what to do.
Sell.
It's a big change. It's a big change. Let's get you some morning calls. First up, Jefferies downgrading Hershey to underperform and cutting its price target to a street low 163. The analyst citing weak chocolate sales. The stock is down 1.8%. Your second call from Bernstein, upgrading Starbucks to outperform. The firm saying market optimism since the appointment of a new CEO is fully warranted. We're up 2.9% there. And finally, Loop Capital raising its price target on Wayfair by $10 to $55 and keeping a hold rating. The firm saying lower interest rates will eventually benefit home-related sales. Turning to commodities, a new wave of stimulus out of China fueling expectations for metals. Copper briefly rallying back towards $10,000 a ton and crossing that level. China's Politburo calling for a forceful rate cut and a backstop to the country's real estate market. Rio Tinto CEO Jakob Stausholm joins us here in New York. Jakob, it's good to see you.
Good to see you.
Fantastic news for you, sir. This makes your trip to New York so much better. 4-day rally on the stock. I think we're up by more than 10% over that period. Can we start with China? What do you make from what you've heard so far? And do you think it makes a big enough difference to your business?
Well, first of all, China is the manufacturing hub of the world, and therefore the economy is hugely important for commodity prices. And China is managing its economy very meticulously. And what you see now is that we know that the property sector has had a very tough time. The manufacturing sector is actually still growing quite a lot, but as they have a target of 5% this year, they clearly have deemed it necessary to come up with some stimulus. And we've seen this again and again over the last couple of decades, and they're able to achieve their targets. It's quite impressive, 5% on a very big economy.
Their approach is shifting, it's evolving. We're hearing more about fiscal stimulus. As you look at your business, iron ore and copper, can you walk us through how strong or weak the demand has been over the last few months?
But the demand has been good. We have good demand. The steel mills in China are running flat out. But I think what you can see is that the steel mill is probably producing a bit more than what the domestic demand is, and that's why you see record export of steel, and you have to ask yourself, is that sustainable? So stimulus, particularly if it goes into infrastructure, is good for the steel mills, who are my customers, and therefore good for us.
Do you have a sense of where the demand is coming from? It used to be just it was directly correlated to China, but now everyone seems to be building out their infrastructure and trying to fortify and create extra kinds of infrastructure pipelines to prevent against some sort of supply chain disruption. How much is it actually shifting away from China?
Yeah, there are other economies that are really booming. For example, the Indian economy, and that drives quite a lot. And then there's different types of infrastructure. So, for example, the energy transition is also about building new infrastructure, building a new energy infrastructure. And if you look at the Chinese economy, that actually boosts their growth quite a lot.
I want to talk about one of the reasons you're here, and whether this quote from the Vice President Kamala Harris is music to your ears. I want to share it with our audience. They're vowing to create a national stockpile of metals to bolster domestic production and security. This was the statement from the campaign. Increased domestic production will be paired with innovative and sustainable steps to build stronger critical mineral supply chains alongside our allies and partners, including by incentivizing investments that expand US and allied production of these resources. Let's pause. Resolution Copper, Arizona. I'm not sure how many people in this country realize we have a deposit that could supply up to 25% of America's copper demand. Where are we with that joint venture with BHP?
So we're trying to progress the project, but it has been for permitting for the last 12 years, so it's a long process. We hope we are towards the end and we can get the land swap going. We're still, and that's very, very important, working with the 11 First Nations around. We need to be sure of that we end up with a solution that they're comfortable with. But from a permitting point of view, I would say we are towards the end of the process. And you're absolutely right. It is a magnificent ore body, a copper ore body. It can produce for decades 25% of the needs of copper in the US. And on top of that, Rio Tinto is one of only 2 companies who has a copper smelter. So we can not only extract the copper concentrate, but we can actually manufacture the final copper here in this country.
But how do you square what Kamala Harris and her campaign are saying with the fact that it was the Biden administration last year that put the brakes on the mine?
Yeah, I'm not in politics, but what I think is interesting with the statement you just read from me is it's a little bit like in the 70s when there was an energy crisis, people started stocking oil. And I think the learnings from COVID is that a little bit more supply chain security is important for industry. We are happy to support that, and that might be also including some kind of stockpilings, etc., to make sure that you just cannot have effective industry unless you have a secure supply chain.
You're still dealing with just the permitting of this project. When could we actually see it working?
Yeah, it's a long process. Where we are now is that we are in the place of need to have a land swap, so that we, some of it is federal land. We have agreed how we can swap with some other land so that we have the whole land. Then we can finalize the environmental all the environmental impact consultations with local communities, and then we can start executing a project. So we are talking towards the end of the decade that we can have production. But then we will have production for the next 60 years.
How much more expensive is it to produce something like copper in the U.S. than, say, some of the other mines that are already in existence?
So that's an interesting question. That's actually not so much whether it's in the US or elsewhere. It depends on the quality of the ore body. In this case, the resolution has a grade of 3.5% copper. Many copper mines have got just 0.5%. And that means you have to extract many more tons to get the same amount of tons of copper. So it can actually be quite efficient extracting copper in Arizona.
We're working our way around the world. I want to go down to Argentina, to the Rincon Lithium project. I think you paid almost $900 million, $800 million for this a couple of years back. You've met Milei this week from Argentina. How's that all going?
Look, I think that there's a lot of opportunities in Argentina. They have been through some really, really tough years, and I hope the government will succeed on reducing the inflation, stabilizing the economy, and ultimately get growth in the economy. We are very happy with a few of the initiatives that the government have done, such as the so-called RIGI legislation incentivizing major foreign investments. That helps us. With our investment, we will produce first lithium by December this year, but we are likely to take a big expansion for sanction in December as well. That could be another $2 billion investment into Argentina. And in the past, it has not been without risks to invest in Argentina, also because you've got the currency restrictions. But we are seeing Argentina heading in the right direction. So I wish the government success. We are very aligned on that interest.
Let's finish on lithium. If I think about the arc of your company over the last decade plus, I think back to Sam Walsh coming out of the China boom. He had to deal with that. Jean-Sébastien Jacques had to do the cleanup. He had to do the value over volume push. That meant pulling back on spending in a big way. You had to come on board and put out a lot of fires. I'm trying to work out from your perspective now, as you start to carve out the business and really start to put your handprint on things, the business mix, historically, taking out coal, we're talking iron ore, copper, and aluminum. Where's lithium fit in years to come? Do I call this a lithium business in 10 years from now? How big could that be?
Lithium will always be small compared to copper and aluminium, but that's not what you should think about. You should think about that lithium is very small today, and a number of new mines will have to be developed in order to meet the demand. If you want to electrify societies, you will need batteries, you will need lithium. And we have the technology, we have the capabilities, so why not chip in there? It can, I believe it can be quite substantial, but it will never be as big as for example, the aluminium market.
Hopefully we can do this again soon. It's good to catch up, sir. Appreciate your time. Thank you. Jakob Stausholm there of Rio Tinto. Up next on this programme, we've got a lot to talk about. Jobless claims just around the corner, 8:30 Eastern Time. A lot of Fed speak as well. We'll speak to Jay Bryson of Wells Fargo and Kelsey Barrow of JP Morgan Asset Management, both here to react from New York City this morning. Good morning. Your data is up next.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
The main event this morning for the equity market, jobless claims just seconds away. So let's start with equity futures on the S&P 500. There's a lift across the board here, up by 0.8%. On the Nasdaq 100, up by 1.5. On the Russell, up by 1 full percentage point. This could change in 10 seconds' time. In the bond market, yields look like this. A 2-year, 10-year, 30-year, shaping up as follows. The 2-year down about 2 basis points at the moment to 353.26. If you're looking at the 10-year, we're down 2 or 3 basis points to 375.64. And a finish on a 30-year yield down 2 or 3 basis points to about 4.11. Ton of data crossing the Bloomberg screen at the moment. What we're looking for is jobless claims. 223 is the estimate in our survey. The previous week is 219. And what we get is 218. 218 on jobless claims. I think we just have to pause here. 218 at any time, going back decades, is tremendously low for jobless claims, historically low. So at a time when we're really worried about the next step in this economy and the evolution of the American economy being layoffs, people getting fired and claims rising, we just don't see it in the data right now. We do not see it at all.
The jobless claims coming in at the lowest going back to May 17th, the week ended May 17th, 2024. At the same time that we're getting the second revision in the first quarter GDP upward, actually now, and it basically is showing ongoing strength. So, big question here, is there still the boogeyman lurking out there, which is the slowdown in the labor market that we're going to see in non-farm payrolls, or the jobless claims just telling us stop looking for it because it just isn't showing up?
So let's push it through the market. Let's start with equities. Equities up across the board. Still, that move sticks. Equities up on the S&P, up by 0.8. On the Nasdaq, up by 1.5. Let's flip up the board, switch up the board, turn the page and get to the bond market story. The 2-year yield was lower, the 10-year yield was lower. Now the 2 years just a little bit higher. So that's the change off the back of this in the last 90 seconds. Push that through foreign exchange. Dollar, a little bit stronger. Euro dollar backing off session highs, 111.48. Just remember, payrolls, a week tomorrow. The estimate's 140. I think the survey week was last week. So this is what we're looking at for next month. Payrolls, is it really going to slow down anytime soon, given what we've seen coming out of the jobless claims numbers over the last month or so?
If jobless claims are the best high-frequency indicator, the answer would be no. At the same time, people have pointed to the fact that you're not seeing jobs getting created. It's not just maybe people getting fired, but that people aren't actually getting the opportunities, and you are seeing that in some of the sentiment surveys. However, there is a discrepancy between the bearishness and the fears versus what we're seeing in the claims numbers, and I think that that's what you're feeling in terms of the lift in yields on the margins in the bond market today.
Jay Bryson at Wells Fargo with us now to discuss. Jay, I'd just love your thoughts on jobless claims at 218. It just screams there's nothing to see here. Everything's okay. Is everything okay?
Well, so you talked about payrolls coming out, right? And so payrolls is a net number. It's it's two gross numbers. What we're getting today in the initial jobless claims is people who are losing jobs. What Lisa was just talking about is creating jobs. And so when you look at the economy, we're not creating a lot of jobs. We're not losing a lot of jobs either. And so when you get that net number out next week, we're 135. So there has been a slowdown in job creation. And what that means is you're just not going to have as much income growth going forward as well.
Is it inevitable that layoffs are next?
I don't think it's necessarily inevitable, because if you look at the financial health of most businesses today, that's actually pretty good. You know, their balance sheets are pretty strong. Their debt service ratios for most companies are very, very strong as well. And so they don't necessarily need to lay people off at this point. But, you know, if monetary policy remains restrictive here, that's going to continue to put headwinds on growth, and that eventually potentially could lead to those jobless claims going up.
Do you get the sense that this market is too complacent about this sort of soft landing nirvana, as we've named it, or is this more an economy that's at risk of a reacceleration, that people maybe are a little bit overly complacent about the inflation side of the equation?
So, you know, if you say what's more likely going forward, a slowdown, more of a slowdown from here or more of a reacceleration, I'm going to take the more of a slowdown sort of story right now, just again because monetary policy remains restrictive right here. I just don't see a huge reacceleration right here. And so, you know, when I think about the risk of recession in the next 12 months or so, you know, the underlying run rate is like 15%. You know, if you said to me, what do you think the risk of recession in the next 12 months is? 1 in 3, 30%, 35%. It's not our base case, but we're not out of the woods, right? I mean, you are seeing signs of stress in the household sector. You're seeing delinquencies on credit cards going up. You're seeing delinquencies on auto loans going up. And people's, you know, the excess money they had after, you know, the stimulus programs are all gone at this point. And so you could get a move to the downside here, although I'm not really expecting that.
If that's the case, why shouldn't the Fed go by 50 basis points in November?
I think there's a very good case for that, but I think it's going to be, I think you were saying earlier, it's all, you know, we're just very, very data dependent at this point. And, you know, they're trying to balance the risk out there. And, you know, could you get a reacceleration? Sure. I don't think it's the most likely case, but, you know, that's still that possibility there. And I don't think they want to go 50 to have to reverse that, a few months from now.
Well, reverse that because of policy out of Washington in 2025?
So I don't think you're going to get a huge policy shift out of Washington in 2025. You know, I think the biggest thing that Congress has to deal with next year is the extension of the TCJA at the end of the year.
And the debt ceiling.
Are we expecting that right off the bat? Probably not, right? That doesn't expire until the end of the year. Knowing Congress is going to take them a long time to do that.
But I guess what about reacceleration of inflation if it came to things like tariffs?
If it comes to things like tariff, you could potentially see that. Now, does that mean the Fed starts to raise rates? I think the Fed, you know, if you were to get a reacceleration in inflation, I think the Fed goes on hold. Everyone's pricing in 200 basis points of rate cuts. That probably goes away. But I think the Fed initially would say wait on hold and see how much it feeds through.
The bulls are getting everything they want over the last week. A 50 basis point cut from the Federal Reserve, Bramo. A read of about 220,000 on jobless claims. Stimulus out of China. What more do you want right now? Does it get much better than this?
I mean, the only thing it would have to be would be some sort of disinflationary shock, like oil prices falling down. Oh, wait a second. That's actually happening because guess what? There might be a race to the bottom now in terms of trying to preserve market share. So, look, yes, it does feel, I'm going to be a broken record like soft landing nirvana. However, and sort of the sort of fly in the ointment, if you would, is this question around what are we missing, and revisions have been lower. And that's the reason why that is going to be the ongoing focus, and we're not totally out of the woods. People can still pretend to worry until non-farm payrolls.
Your jobs report a week tomorrow. We are still vulnerable to one data point in this market. It goes the wrong way, this market turns.
Do you think we're getting less vulnerable, though, given all of the stimulus and the sort of rate-cutting cycle from around the world? I mean, there is sort of a feeling of...
It certainly helps.
Yeah, I think that there is less fragility in some of the confidence that people have today than they did, say, even a week ago.
218 on jobless claims. We were looking for 223. Yields are up by 2 basis points on a 2-year, 358. Jay Bryson of Wells Fargo. Jay, thank you, sir. It's good to see you. Appreciate it. Thank you. Bit of news for you in the last few minutes. The number's 25 billion. Citigroup, Apollo, joining forces in a $25 billion private credit push. With the latest, let's get across the Bloomberg Sonali Basak. Hey, Sonali.
Hey, John, you have a landmark deal happening in the world of private credit, of course, a fast-booming industry, along with one of the top global investment banks in the world. What you'll have here is Citigroup teaming up with Apollo, which is the largest direct lender of its kind, as you know, in order to provide $25 billion worth of financing here. The idea here is that Citigroup would look to originate the deal flow, take a fee off of that flow, and Apollo and its partners would provide the capital. Among those partners is Abu Dhabi's Mubadala, of course, a very prominent sovereign wealth fund that has been taking a bigger role in the world of private credit. But of course, fundamentally, this brings together two teams that have had very close ties over time. You may remember Apollo's own co-president, Jim Zelter, used to run that team over at Citigroup that dealt with leverage finance and high yield financing. You now have Citigroup in a position where they are the #2 investment grade underwriter in the United States, but they have not met the top 5 this year. When you look at high yield and leverage loans, presumably this will help them reach more clients in order to do so, with giving Apollo many more deals to finance, and of course corporations as well. Zelter has told us that they expect to do about $5 billion worth of deals in the first year, and both teams are looking to keep the door open here to expand this beyond $25 billion.
Shanali, appreciate it. Thanks for the update. City up in early trading. Looking ahead to a big conversation around Apollo for next week, so watch this space. Our friend Jim Zelter over at Apollo saying this is where the industry is going. Citi goes from a very active M&A banker with a few tools, Lisa, to having the complete toolbox.
And it comes as a lot of the big banks have been questioning exactly how they can fit into the behemoth that is private credit that's been expanding and continue to keep some of the business that used to be squarely in some of those large banks. This is a solution, I guess.
Watch this space. Plenty of discussions on this with Shanali at the top of the hour in about 20 minutes' time. I want to turn back to the price action, up 0.8% on the S&P 500. Moments ago, we had jobless claims data out of America. We were looking for that number because that number really separates right now the equity market bulls and the bears. Comes in weak. At the moment, the bears are going to jump on board and say, look, things are turning lower in the economy. Comes in strong. The bulls are justified to be long stocks. Came in strong, 218, Lisa, versus an estimate of 223.
And the response is everything is up. In particular, you've got the Russell 2000 up more than 1%. As you've got yields just creeping a little bit higher, you do wonder how high the bar is now to get the bears to reemerge from the woods, because they are kind of hiding at this point. And so there's a real question here of, would it now just take one bad non-farm payrolls to get people spooked once again about the idea of some sort of downturn?
Let's get to Kelsey Barrow of JP Morgan Asset Management. And Kelsey, good morning to you.
Good morning.
How vulnerable are we to a soft print on payrolls 2 Fridays away?
Well, there's two things to consider. One is how vulnerable are we, and then what is most likely to occur. So the initial jobless claims today suggest that the expansion should continue. The labor market is healthy. Now, if you were to ask me where the balance of risks is, I would say the balance of risks is to the downside. It is to the risk that payrolls growth slows more and the unemployment rate rises. I know there's this debate. If the Fed sees payrolls growth below 100,000, then that's the green light to do another 50. I think we forget that we already had a payrolls print below 100,000 2 months ago. So payrolls growth already is slowing. Now, this is the most new information that I feel like I've learned in the past few days in terms of Fed communication, is that actually, while the market is focused on the debate about 25 versus 50 being primarily about the labor market, some participants are actually opening up the door to additional 50 basis point rate cuts just on inflation alone. And that's why I think, you're not going to necessarily see materially higher yields just because the labor market stays around here. There are other reasons yields should remain low and should be biased lower because of the inflation backdrop alone.
Just to back up, was that Governor Waller that made you start thinking that way?
It was, although to be fair, we've been thinking about it this way for a while, which is that the Fed has justification to cut probably 100 to 150 basis points just on the improvement in inflation alone. And then you couple that with what we're seeing in terms of inflation expectations, inflation break-evens, the commodity complex, the global growth backdrop, and I think they can feel fairly confident that there is space for them to ease, and that's kind of agnostic to, does the labor market stabilize around here, or does it continue to move lower?
One of the most controversial aspects of your whole case is that you see this as a reason to buy bonds across the entire yield spectrum. When people come on this show, they have increasingly said, I'm comfortable with it up until about 5 years, and then after that, forget it. Because I have no idea what's going to happen, and potentially we could get even inflation coming back or being stickier because of a proactive Fed. How do you push back against that? Because I'm sure you hear that a lot.
Well, I mean, when you think about what we are recommending that clients do here, what we've found when we look at the client base is that despite the fact that the Fed has finally come in after 14 months of being on hold and cut rates 50 basis points, there are still many clients that are under-allocated to fixed income and over-allocated to cash. And so there is still a lot of room to move out in terms of duration. Now, in terms of how I think the term structure of the yield curve is going to evolve, I do think that the curve is biased steeper. So you are going to see front-end yields move lower than long-end yields as the Fed continues to deliver those rate cuts. But I do think that when you're thinking about building a portfolio that has diversification, you can think about a core or core plus fund with a 5 or 6 year duration, which is what you're going to get when you buy one of those full bond funds that invests across the whole maturity spectrum. And that's going to give you both the income and also the benefit of capital appreciation if the claims data is not the real signal, and in fact, the terminal rate for the Fed is not 3, but lower.
In this picture, there's a real question about if you're more biased to the potential for downside risk, why should you go into riskier assets?
So I think there's a couple reasons. First of all of this in terms of the timing and transmission of monetary policy is very uncertain. The lags are very unclear. So we do feel like we're getting closer to reaching an inflection point, but it's not clear which way the economy is going to break. So on one hand, the Fed cuts 50 basis points, and in 12 months, if they succeed in extending the cycle, we could be looking at reacceleration. In that case, spreads should remain very tight here. On the other hand, if this is like every other time in history, then the 50 basis point cut is actually not a proactive move that extends the cycle, but a signal that they're already too late. And to balance those things, I think you need both a combination of duration and high quality, but also some carry in your portfolio, because the outcomes, both tail risks are possible at this moment.
Kelsey, we've got to leave it there. It's always great to catch up. Thank you. Kelsey Burrow there of JP Morgan Asset Management. We count you down to the opening bell. 45 minutes away. Equities are still higher by 0.8% off the back of that better than expected jobless claims number. Yields just a little bit higher. Up next on the program, we'll run you through the day ahead, and we'll catch up with this man right here. A conversation you do not want to miss. The NATO Secretary General, Jens Stoltenberg, right here in New York City. Up next.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
is on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
As we count you down to the opening bell, here's the trading diary. The week ahead, the day ahead looks like this. A slew of Fed speak on deck. We'll hear from Collins, Kugler-Bowman, Williams, Barr, Cook, Kashgari, and Fed Chair Jay Powell. Then Costco reporting after the closing bell, and the UN General Assembly still ongoing. This is President Biden and Ukrainian President Volodymyr Zelensky, a meeting in D.C. this afternoon. Joining us now around this table, I'm really pleased to say the outgoing NATO Secretary General Jens Stoltenberg departing the organization after a decade. Sir, it's good to see you.
Thanks so much for having me.
Thanks for sharing what I believe is your final interview in the job. Thank you, sir. You've been very kind to Bloomberg over the years, and every time we've spoken to you over the last decade, you've always been generous with your time. So thank you. Thank you for that. If I think back at your tenure over the last decade, I can think of two really big wake-up calls for the organization. One was Trump being elected in 2016 and really putting the foot on the throat of some of the people who were part of this organization to spend more on defense. The other was the invasion of Russia into Ukraine more recently in the last couple of years. As you step back and think about your tenure the last decade, what stood out for you?
The most, of course, decisive and important challenge we faced was the Russian full-scale invasion of Ukraine. But we have to remember that the war in Ukraine didn't start in 2022. It started in 2014 when Russia went in and took Crimea. And since then, over the last decade, NATO has implemented the biggest reinforcement of collective defense because of Russia's annexation of Crimea. So when the full-scale invasion happened in 2022, we were prepared. We had more forces on higher readiness, for the first time battle groups in the eastern part of the alliance. So when it happened, the full-scale invasion, we were able to step up our support for Ukraine and increase our military presence in the eastern part of the alliance. So Ukraine has been there throughout my tenure, but it has gotten worse.
Let's talk about the potential path forward for Ukraine, especially given the fact that we have this U.S. election looming over the crisis. Donald Trump was talking yesterday about Zelensky, saying that he was making nasty aspersions about him. That had to do with this New Yorker article I'm sure you've seen, but what he said about J.D. Vance, also the fact that he went to Pennsylvania, which is a swing state in this country. Do you think Zelensky miscalculated this political situation right now in the United States?
I'm convinced that President Zelensky is ready to work with whoever is elected as president in the United States. And I also know that President Zelensky worked with President Trump when he was president of the United States. And also that during that time, actually, the United States increased its military support to Ukraine. It was during the Trump administration that the decision to provide lead-laid javelins to Ukraine was taken. So it's not for me, and it's not for President Zelensky to have any opinion about who the American people should elect, but we need to work with whoever is elected to ensure continued support for Ukraine.
I guess I'm confused because there's been a change of attitude from President Zelensky. He sat down with me in July and basically said he wanted to get into a room with Trump. He wanted to see the plan Trump had when he says, I have a path to victory. And now he comes here and he's kind of poking the bear. What he says about his running mate, and the fact of the matter is, Trump is not going to be meeting him along the sidelines of the UN General Assembly, and that probably goes back to what Zelensky has said about him.
But you know, it's not for me as Secretary General of NATO to try to facilitate a meeting between President Zelensky and Donald Trump. What I can do is to convey to the United States, to all NATO allies, that it is important that we continue to support Ukraine, because this is not only about Ukraine, it's also about our own security. If we allow President Putin to win in Ukraine, it will be a tragedy for the Ukrainians, but also dangerous for us, because then the message to President Trump is that when he uses military force, he gets what he, to President Putin, is that when he uses military force, he gets what he wants. And that feeling, it's a floor. And we also have agreed in NATO new defense plans, which require specific capabilities, forces, readiness. And for allies to provide those forces we have agreed that they should provide, they have to spend significantly more than 2%. Whether that's 2.5 or 3, I will not give you a exact number, but it's significantly more than 2.
Do you think that NATO is significantly stronger or significantly weaker than it was when you took the office?
There's no doubt that NATO is significantly stronger. We are spending much more on defense. We have many more troops on high readiness. We have more high-end capabilities. We have battle-ready troops in the eastern part of the alliance. But the challenge is that the world is more dangerous. So the success of NATO is that when the world changes, we change, and that's exactly what we have seen.
The issue is that NATO members may not agree on where the dangers are and exactly how to deal with them. How do you see NATO facing off with certain economic and potential military threats from, say, China and other countries where it's a little more complicated in terms of the members?
Well, we are 32 allies, and of course, sometimes it takes time to make 32 allies representing 50% of the world's GDP, 50% of the world's military might to agree. But the good news is that on, for instance, China, we have come a very long way. Not so many years ago, NATO didn't have any unified policy on China. Now we have a very clear position that China matters for our security, that China cannot continue to enable Russia's war aggression against Ukraine without consequences for its interest and reputation. And allies have also agreed that we need to work more closely with our partners in the Pacific, Japan, South Korea, Australia, as a response to what we see China is doing.
We could talk to you all day, but we're running out of time, so I have to squeeze this in. And it's rather selfish. Do you know a guy that might be able to help us set up the show, take it on the road to the Munich Security Conference anytime soon? Do you know someone we might be able to call?
But, you know, the Munich Security Conference is a very good platform to discuss security issues, but I will not give you a specific name for who can help with that.
I'll get in touch in a number of weeks' time, and hopefully maybe that will change. Yeah. Thank you, sir.
Thank you.
Thank you so much for everything over the last decade. We appreciate it. We really do. Thank you. The NATO Secretary General, Jens Stoltenberg there. Coming up tomorrow, here's the lineup for you. We'll catch up with Sebastian Page of T. Rowe Price, the former World Bank President, David Malpass, Tom Steyer of Galvanize Climate Solutions, and Christina Campmany of Invesco. Bramo, this market ripping into the opening bell.
How many nodes of stimulus can you get from the U.S., from China, potentially the ECB, from Saudi Arabia? It seems to feel a little bit like something that rhymes with Moth Landing,
something
Nirvana.
Like that. Just need to end some wars.
Yeah, exactly. That's exactly right.
That would be perfect.
Please.
From New York City this morning, good morning. This was Bloomberg Surveillance.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
First of all, global trade, which had adverse consequences that we're learning about to this day, still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar. They're leaders in EVs. They're leaders in a number of emerging technologies. In a world which is more splintered, we'll see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, the United States is a clear leader in AI, along with a number of the European countries. And those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage.
The names that move markets are on Bloomberg.
Our role in the world, our role in NATO in supporting the Ukrainians in this war,
the unprovoked war that Russia has instigated in Ukraine, our support for the Indo-Pacific, for providing a counterbalance to China. All of that is in our interest, and whoever's president, I'm sure, is going to do what's in the best interest of the United States.
It is not a time for America to back off of its commitment around the globe. And I think there's a justification for us making certain that we do the right things in a way that we share the burdens with our allies. But I don't expect America to walk away from the world in any administration. It's about American security, and it's about making certain our adversaries, present and future, know that when America's committed to something, they're there for the long haul.
Bloomberg. Context changes everything.
We are getting amped up for another record high in stocks. 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Sonali Bassett.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, Micron serves up the latest serving of AI optimism. The chipmaker is delivering surprisingly strong sales and profit forecasts.
Meanwhile, a lot is in flux. At OpenAI, we'll discuss the potential changes underway from rethinking its nonprofit status to Sam Altman's potential equity stake and another executive exit.
Plus, Citi and Apollo join forces to shake up the private credit market. We've got the details on one of the most ambitious tie-ups in the industry. All that and more coming up, but let's take a look at where markets are trading. 30 minutes to go until the bells ring, and as Matt said, right now we're looking at record territory. The S&P 500 recovering from that small decline that we saw yesterday, currently up about 0.8% pre-market. Big tech, one better, of course. The NASDAQ 100 up about 1.6%. We got more stimulus out of China. We got Micron ripping. And, of course, we got some economic data that we'll discuss. You add it all together, pretty quiet in the bond market, all things considered, Matt. The 10-year yield only up about 1 basis point.
Yeah, the economic data is good news, and it looks like that's good news for stocks right now. Here you see in blue the economic surprise index. It's finally turning higher, and that's because in white you can see the U.S. economic surprise index really ripping up with the labor market impressing. Initial jobless claims remain low at 223,000 for the week.
All these records are almost getting boring, aren't they? But let's take a look under the hood here, because there is some more optimism when we take a look at stocks. Micron just soaring, helping lift the tech sector after reporting strong earnings and lifting its outlook, helped by demand for its AI products. You have Micron up now 17.7%. I've got to say, Micron's gains have been accelerating this morning. CarMax had reported net sales and revenue that beat this morning. However, the company added an extra $15 million to its loan loss projections. You have CarMax now down 5.4% pre-market. Citigroup up 0.6%. It had announced a landmark deal with Apollo for a $25 billion private credit push. You also have Apollo shares now up 1.2% pre-market. We'll talk about that later in the show, Matt.
Yeah, we will focus in on that big private credit scoop. Let's talk, though, about what's going on with these records. I mean, we had good news on the labor front, right?
We did.
We're not getting a lot of layoffs yet.
We aren't.
And we had good news on the GDP front.
We certainly
We're still
did.
seeing a lot of growth.
We are, yeah. The economic picture looks good right now. You also have more China stimulus. Again, not the all-at-once big bazooka, but the steady drip of stimulus coming out of China. And then you also have Micron ripping, and you add it all together, we're looking at records, and life is pretty good.
Life is pretty good, but the other thing about this that really gets me is you do have the government supporting economies around the globe still. I think that China story is so interesting. Your point about whether the Fed needs 50 after that strong data is also really interesting this morning, Matt, because market expectations have not changed by a whole lot. Why would the Fed go 50 with inflation where it is and the labor market where it is? We'll talk a lot about it in this show.
You could ask the same question when it relates to September, of course, and the Fed still did go 50. So who knows? Of course, as Sonali says, we will discuss it. But let's get back to the AI story, because Bloomberg sources say that OpenAI is weighing a 7% stake for CEO Sam Altman and restructuring as a public benefit corporation tasked with turning a profit and also helping society. Bloomberg Technology's Ed Ludlow co-wrote that story. He joins us now from San Francisco. And we heard from Sam Altman this morning, of course, at Italian Tech Week. And he said that the executive departures are not related to a restructuring. Walk us through what we've learned and, of course, those latest comments.
Yeah, so Mira Murati, who's the Chief Technology Officer, made a public statement yesterday that she has resigned effectively, and what sources tell us is happening in the background is she's still at OpenAI and is negotiating an exit. Murati is important. She's part of the intellectual capital of the company, but this is a high-profile exit. At the same time, we report, according to sources, that they're looking at options, right? This has been discussed for a long period of time to reorient and reorganize the structure of OpenAI to a B Corp, which for those that have never heard of a B Corp is basically a company that is for profit but has its lofty or societal goals codified in its legal documents. You still make money, but you help the world doing it. And the 7% stake that Altman would get is a part of that negotiation, because what you need to know is that he currently does not have any equity in the firm. And I think it's really important to state that we actually don't know what that 7% would look like. And we've not done any back-of-the-napkin math on it either.
I have done some back-of-the-napkin math on it, and if they raise $6.5 billion and they're worth $150 billion, that means Altman's 7% stake would get him $10.5 billion, and that's always, I think, a good incentive for CEOs, Ed, when you give them $10 billion.
Yeah, I mean, I go back and say, well, we don't know if it's an equity grant or award, or is it in the form of options or a schedule of grants with a vesting schedule or something like that. That's why we don't know for certain. Sam Altman has talked about this idea, well, I don't have any equity in OpenAI, and in interviews he said, but I kind of wish I did, so you'd stop asking me about it.
And so I'd have $10.5 billion. That's why I wish I had equity in it.
First of all, I love it when Matt gets nerdy and does math on the back of an envelope. Also, Ed, how does this change incentives for OpenAI? I think that's really the important part of this. If you have him getting so much equity and moving more and more away from that nonprofit goal.
This is at the core of the story, right? So when OpenAI was founded in 2015, it was as a non-profit, a charitable organization with the idea of developing AI for the benefit of mankind, right? That the goal is more narrowly focused, that the technology you're building serves society. And if you are approaching it with the goal of making money, then that original pure vision is tainted or not as attainable because of your commercial goals. Now, to go back to the original question at the start of this conversation, and Mira Murati, Sam Altman came out to Katie's point this morning at this Italian Tech Week and said, Mira's departure has nothing to do with talks about a restructuring, and what we don't know is whether she disagrees with that philosophical principle, whether or not OpenAI should be pursuing purely commercial goals or not. That is the tension here. But Matt makes a valid point as well, which is OpenAI has commercialized now. It's growing incredibly quickly on both the consumer and enterprise arms of its business, and it is bringing in some revenue. So the valuation that the investors who are clamoring over it are discussing reflects that.
Ed, we could talk about OpenAI and all the C-suite drama that we're seeing at that company for the entire 2 hours, but I can't let you go before I ask about Micron, because, of course, the company reported earnings last night. The shares are up 18% pre-market. Of course, it's been a rough ride for memory chip makers, so maybe expectations were low, but walk us through that. I mean, shareholders clearly psyched this morning.
Sure, the earnings and the equity story are now matching what is happening in the real world. Micron's up 18%. The guidance for the fiscal first quarter of $8.7 billion of revenue, boosted by AI sales, was ahead of expectations. And really simply put for our audience, if you walk into one of the data centers we've all been talking about, go up to one of the server racks, pull out one of the drawers that has an NVIDIA GPU in it, around the outside of that NVIDIA GPU will be about 8 Micron HBMs, high bandwidth memory chips. And so that's the logic here. If NVIDIA is seeing all this sales growth from AI, it's almost directly proportionate that Micron, that is making a successful high bandwidth memory chip, would also see demand because the NVIDIA systems that are being sold are also using that technology. We're talking about the latest generation of NVIDIA chip. And so that's now being reflected in earnings. And you know, the history lesson is that Samsung used to be really good at high bandwidth memory. It's kind of fallen behind, and Micron has kind of jumped ahead in the technology race, and investors are rewarding that.
Well, they say they're the only ones who can actually produce it at scale reliably. I learned so much from Ed Ludlow.
I love that guy.
High bandwidth memory is just one form of dynamic random access memory chip. Ed, thank you so much for joining us. Bloomberg's host of the technology show, Ed Ludlow. You can catch his program at 11 o'clock. Now, let's talk about all this with Andrew Slimman. He's a senior portfolio manager at Morgan Stanley Investment Management. And Andrew, as far as I understand it, you still expect an S&P 500 at 6,000 at year end. Does that continue to be driven by this AI craze, by good news out of Micron and NVIDIA?
Well, yeah, look, I mean, you guys framed it great at the open, which is you have a combination of good corporate fundamentals that continue to report good numbers overall. So estimates for next year, which is important, continue to go up. And you have incredibly accommodative central banks. So I think more liquidity induces higher risk, and corporate fundamentals that justify owning stocks, and that's pushing the market. What surprised me is kind of the typical presidential election schedule where the market gets anxious. That's been put on the back burner, at least for now.
If that's on the back burner for now, that kind of anxiety, then what do you expect the lead up into the election to really look like, Andrew? Because you're seeing so much exuberance. You have the market barreling towards another record high. Once again, you are seeing love outside of the tech sector, and then you're seeing more optimism in the tech sector once again as well. Where do you place your bets, and do you expect those bets to perhaps face some drawdown heading into the end of the year?
So look, and before I get to that, I would add one more thing to that question, which to your point is money market yields are coming down. So that's going to induce at the end, induce money to come out of money markets and go into risk assets. So that's another bullish argument. In terms of what I expect, I thought there would be more anxiety, even though the Fed was cutting, about the election, because that's typically what happens when you have one of the candidates who has not been president, which is why the VIX really didn't spike in the first half of the year, because both candidates had been president. And then once President Biden dropped, the VIX did spike, and that's kind of the typical playbook. And now we're focused on other things, so the VIX has come way down. I still expect more volatility going into the election, but at the end of the day, I'm no political expert, but as long as we have a divided election, I think the market's going to power into year end, and it's going to be led by the things that have led all year, which is AI, GLP-1, industrials, financials. I think those will still be the stocks to play. And I know that's hard because people go, oh boy, they're up a lot. I want something contrarian.
And we own them already.
Usually, yeah.
Exactly. So, but those are the themes, of course, once we get through the election. And to your point, it sounds like you're saying a divided government would be the best case here. I want to talk about the other news of the week, though, and that's what's coming out of China. All of these stimulus measures that we're seeing, I think, for the past 2 or 3 days. It was interesting. You heard David Tepper actually speaking on CNBC this morning saying that this is a buy everything moment in China. When you take a look across the sea, when you take a look at what the Chinese government is doing to support the economy and particularly the property sector, how are you reading that, and how does it flow into the U.S.?
I mean, from a Chinese standpoint, I agree with them. You have a cheap market, and you have decent fundamentals, and you have big stock buybacks in China. So I think he's right in terms of the liquidity is flowing back into the markets. You always have the uncertainty of the government and pronouncements, but I think that makes sense, and that will flow through to the rest of the markets around the world, especially Europe, where you have a big part of the index, the luxury stocks that are so geared towards what's going on in China, and they've been hurt by that the last couple of years, those stocks could see a recovery as well. And I think it's good for the U.S. The drawback for the U.S. is you have a dramatically higher priced market than you have in China and Europe. Doesn't mean there aren't good ideas, as I've already listed, but I think what's key here is you have to own companies that have the ability to beat and revise up their numbers, because on a standalone basis, I think stocks in general are expensive for their growth rates unless the denominator is low, and that's what we're seeing today. And that's what we've seen, say, in the AI stocks. So when I say denominator, I mean the E of the PE.
Andrew, what do you do if, I mean, you're already fully allocated to NVIDIA and Novo Nordisk. Let's say you have enough risk on an AI and GLP-1s. What else can you buy out there, or are those the only two themes that really matter in this market?
No, I mean, I think there's other themes, and so they seem to, what I like about those two ideas is they don't zig and zag together. They're two very different themes, but there's other themes. I think the industrial play in the United States in terms of the infrastructure is very significant. We keep hearing this from companies. I keep getting questions from investors saying, oh, but it's all going to run out in 2024. I think that is massively misunderstood. There's a long tail to these projects. So I think industrial plays on that are huge. And then I think the financials and specifically the asset and wealth management industry is going to benefit as money comes out of money markets and chases into higher risk assets. You tell me, Matt, is it at 4% when people say, my money market, big bloated yields, bloated assets aren't good? Is it 3%? I don't know the number. I just know directionally money is going to chase into, it's not going to all be equities, but higher risk assets, and that's good for financial industry.
All right.
It's a great point, Katie.
Yeah.
I mean, a lot of people are saying, like, I'm no longer getting 5% on my Marcus, so got to get rid of that cash.
4%, though, it sounds pretty good. We'll see. There's $6.3 trillion sitting in money markets. And, Andrew, as you say, the direction of travel is clear. Unfortunately, we have to leave it there. Hope to have you back soon. That is Andrew Slimman of Morgan Stanley Investment Management. Now, coming up, Citi and Apollo enter a $25 billion pact to take a bite out of the private credit market. We'll take a look at the deal's impact on the market next. This is Bloomberg.
Top names in business are on Bloomberg.
The challenge for us now is not very much on the product, it's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp-up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything.
Let's get to high interest now. Look at what's making headlines around the world. New York City Mayor Eric Adams has been indicted following a federal corruption investigation. That's according to people familiar with the matter. Mayor Adams vows to remain in office and fight the charges. He spoke last night after the news of his indictment was made public and accused the federal government of lies. On U.S. steel, Democratic presidential nominee Kamala Harris made it clear keeping domestic control of steel production is important. More important than the possible job losses if Nippon's proposed takeover of U.S. Steel falls through. The U.S. Steel CEO said earlier this month it would have to close plants and move its headquarters from Pittsburgh if the $14 billion deal doesn't go through. And Hurricane Helene is pushing deeper into the Gulf of Mexico. It is forecast to make landfall in Florida this evening as a full-blown Category 4 storm with winds at 90 miles per hour. The U.S. National Hurricane Center warned that preparations to protect life and property should be rushed to completion. Shanali.
And Matt, we're going to talk about that story that is just lighting up the terminal this morning. Wall Street heavyweight Citigroup and Apollo decide to get into the ring together. The two are teaming up in a 5-year, $25 billion push into the world of private credit. Mubadala and Athene will also be part of this venture, and it's going to focus first on North America. Here's the interesting thing, and we spoke to Jim Zelter about this. Jim Zelter is the co-president of Apollo. Remember, Zelter used to work at Citigroup. He ran the business, guys, that did a lot of these debt deals. This was a business where you had the banks and the private credit firms and a fierce rivalry until, say, last year. You saw Wells Fargo do a deal with Centerbridge. You saw JP Morgan try to start their own venture of sorts. You have Goldman raising money in their private asset management arm. And now you're seeing a landmark deal. You have Apollo and Citigroup really striking one of the largest deals, maybe the largest deal as we know it in this world.
So something I've been wondering, and obviously $25 billion, that's huge. And Chanel, you can mention you broke
PSUS.
That's exact. Well, it's what PSUS wanted to be. We'll see if that does come to the public markets. But I'm wondering how much of this private credit enthusiasm that we've seen is a higher rate phenomenon. There was a really interesting sort of sign of the times story on the terminal the other week that Algius actually refinanced a private loan that it got from Vista in the public markets, that basically they saved about $75 million in interest by doing that. So as rates come down, I mean, does some of the steam come out of the private credit market?
It's a really good question, and we've been seeing that all year. It's been certainly already happening because you see so much demand in the broadly syndicated market. You are seeing companies really go to public markets at a pretty low rate. So yes, that push-pull is very real. For the sake of Citigroup, right? You have Citigroup here as the #2 underwriter on investment-grade deals, so massive debt underwriter here, but in high yield, in leverage finance, they have dropped out of the top 5 more recently. And the hope is working with Apollo here will help them push back into that top 5 and work with those kind of riskier companies and private equity buyouts as they come.
But wait a second. So they're not doing well in high yield, and they don't have a strong enough private credit arm to do it on their own.
They don't have a private credit arm to do it on their own.
So they have to link up with Apollo because they can't do this. They have, how many 100,000 employees do they have? Can't they do it in-house?
This is such an if you can't beat them, join them story. So Apollo keeps saying, hey, Citigroup has 1,700 employees that work on these types of deals. That's corporate and commercial bankers that scour the globe here to make this done. This is North America, but they could here expand this globally as well. $5 billion, guys, is expected in the first year. Remember, $5 billion is what we've reported that Apollo could be investing with Intel alone. Right. So you can get there pretty quick.
Sorry, I have to correct that. 200, at least according to the terminal from June, 238,000 employees at Citi.
Appreciate that correction. It is noted. Fascinating story, of course. A lot of money that we're talking about when it comes to that Citi Apollo venture for private credit. Meanwhile, let's take a check on the public markets right now. About, I don't know, a few minutes until the bells ring. You can see we are looking at a big, strong rally. The S&P 500 up 0.8% pre-market. The NASDAQ 100 1.6%. That's your leader, but small caps putting up a fight as well. The Russell 2000 currently up more than 1% before the bell. This is Bloomberg.
loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
And Fed Chair Jerome Powell, he just gave pre-recorded opening remarks at the 10th annual U.S. Treasury Market Conference. He didn't comment on monetary policy in the speech, but of course, he did talk about the importance of the Treasury markets. It would have been pretty amazing if he said that they weren't important.
Yeah.
Biggest, most
Guess
deepest.
what?
Yeah, you guys
The
are
Treasury market matters.
all these bond traders that are at that conference. Powell thinks you're very important. Meanwhile, let's take a look at futures right now. Of course, minutes before the bells ring, and as we've been talking about, boy, are we back. You take a look at the S&P 500, currently up 0.8%. You have big tech out in front, of course, helped in a big way by what we learned from Micron last night, that revival in memory chips and that AI demand clearly helping Micron and clearly helping the NASDAQ 100 today. And your small caps, of course, they're putting up a fight as well. The Russell 2000 up 1.2%, outpacing the broader market. We'll continue to keep an eye on that, of course, as we push to the opening bell. This is Bloomberg.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions. authorities.
Could face bigger challenges next.
Was going to keep rating World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
We are moments away from the start of trading, set up for a 42nd record high on the S&P 500. This is Bloomberg Open Interest. I'm Matt Miller. You can see futures up 0.8% on the S&P. NASDAQ futures up double that right now after Micron beat on both earnings and its forecast for sales and revenue, saying that customers want their high bandwidth memory chips, which are so useful apparently in artificial intelligence. On the New York Stock Exchange, BKV celebrating its IPO, and on the NASDAQ market site, you have BioAge is going to help us, I guess, age better. I'm really looking forward to that. In terms of the markets here, as long as we stay on track today, the good news of the labor market, we got low initial jobless claims and growth. We got high GDP. Looks like it's going to be good news for stocks. Katie Greifeld, what are you seeing?
Well, you're right. We've had 41 record highs so far in 2024. Will we see 42? Remains to be seen. Stay tuned. But at least for right now, we have a big rally on our hands. The S&P 500 currently up about 0.7%, but all the action is in big tech right now. The NASDAQ 100, of course, up 1.4%, helped in a big way by Micron, which we'll get to in just a second. But I do want to highlight those small caps. That Russell 2000 also roaring back here, up 1.2%. Let's focus in on Micron, though, because it's absolutely surging this morning after reporting strong demand for its products that help train AI models. Of course, yesterday it boosted its forecast, and that's helping to lift shares for the sector overall. You can see Micron currently up about 19%, Shanali.
Katie, I'm also watching shares of Citigroup and Apollo. They have agreed to work together on $25 billion worth of private credit deals over the next 5 years. Interesting to see how the market reacts to this, and it is higher. 1% for Apollo. Remember, $25 billion is roughly 5% of their credit assets. Citigroup also up 0.8% on the prospect of working on more deals, Matt.
All right, CarMax is also lower despite reporting earnings that topped expectations. However, the company added an extra $50 million to its loan loss projection. So that's definitely something that people are concerned about, right? Consumer defaults. Also noting shares of Southwest Airlines, they're going the other direction, up 10% on a $2.5 billion buyback. As part of its turnaround plan, it's certainly working for the shares. Let's get back to the semiconductor sector, though. Right now, let's get Bloomberg's Abigail Doolittle in here to take a look at some of the charts for us. Micron absolutely soaring.
Absolutely soaring, Matt, and it makes that 10% gain for Southwest Airlines, which under normal circumstances would look robust, look somewhat paltry because these shares up 19%, the best day since 2011. So a big, big leap here having to do with the fact that, yes, the company did beat estimates top and bottom, but it really has to do with the guide. So what we're taking a look at here relative to the guide is much more robust than expected. The first quarter revenue now expected to come in at $8.7 billion. That's 5% better than where the street had been. Earnings of $1.72 per share. That's 15% better than where the street had been, having everything to do with AI and a lucrative new chip called the high bandwidth memory. Now let's put this into the context of the stocks and in fact Micron on the year. This is really pretty interesting. So Micron earlier this year in blue had been up as much as 80%, but then after we had NVIDIA and some of these other AI stocks fall as investors wondered whether or not the AI craze was worth it, you can see that it was basically underperforming both the stocks and the S&P 500. But now we have Micron above both of those estimates, up 32% on the year, again, outperforming the stocks, but the stocks juiced in a big way too. Katie, we have that stocks now up on the day over the last 3 days, higher by, I think it's like 5 or 7%. Actually, I think it's closer to more than 10%. So these chips really on fire.
Yeah, it's wild. Of course, Micron up 20% at one point already this morning. That is the biggest one-day gain since 2011. So some fantastic size and scope there. As Matt points out, though, of course,
yes,
it cratered this summer. That was the word you used. Southwest, I just want to hit one more time. Of course, that big gain that we're seeing, that is the biggest one-day gain so far since November 2020. You'll remember that's when we got the announcement of Pfizer's COVID vaccine news. So really tells you just how jazzed investors are about that story right now, currently up about 11%. Let's broaden out this conversation, though, with Kestra Investment CIO Kara Murphy joining us now. And Kara, I want to go to the first line in your notes. You say that policymakers should continue to be vigilant about inflation. And that caught my eye, since it seems like policymakers and investors are happy to say inflation's over, declaring victory. How much of an upset would it be then if we got a surprise to the upside on some of these inflation readings?
Well, I think even just to remember how much expectations have changed over the course of the last 9 months. So as of end of 2023, Fed fund futures markets were anticipating below 3.5% on the Fed funds rate. It peaked at 5%, now we're at 4%. So even in the most recent Fed rate cut, it was only the few days before that cut that the market coalesced around a 50 bip rate point cut. So I just say that to highlight how much change there's been in this viewpoint about where the Fed is going to go. And I think in this cutting cycle, there's been an unusual amount of uncertainty about how quickly the Fed is able to put on the brakes or the gas, depending on which way they're going. And I think the question is, it's still very much a question. And you know, use Europe, for instance, which started a little bit earlier in its rate cutting cycle. There are still signs that, you know, the economy is starting to slow. And then there are signs that inflation is reigniting a little bit, not a lot. But again, like, you still have these two dueling forces, and I don't think the battle is won quite yet.
I'm waiting for someone, Kara, to say that the Fed is cutting too soon or too much. I mean, 3% growth, 4% unemployment, right? Initial jobless claims are at 220. Earnings are up 12% and expected to be up 18% next year. Why do they feel that their rates are restrictive? Where do you see that?
I think all those numbers that you just listed suggest that we have a very healthy economy and that inflation is okay. It's a little higher than where we'd like it to be. What policymakers are looking at is where that trend takes us 6-12 months from now. So with the sort of like weakening in the job market that we've had, job market really rarely sort of makes a move and stays there, right? So you genuinely have to be concerned about this continuing, you know, fewer number of jobs being created, harder for people to find new jobs. And if that kind of continues for another 12 months, it's a while before the Fed can really correct that. So, I mean, that's a really genuine concern. And that's why it's a little bit of art in terms of determining where the policy rate really should be.
It's interesting, Kara. You take a look at even places in the market where there could have been concern. You had CarMax, for example, where there were worries about loan losses, down pre-market, back up into the opening trades. And you have investors all over the place shaking off any concerns about the consumer. You could see why when you see data as strong as it is right now. But is that prudent, given how the consumer seems to be weakening, particularly when you look at lower and middle income consumers?
I think you highlighted the areas where there are real, genuine concerns. So if you look, for instance, at mortgage delinquencies, they're very, very low. Credit card delinquencies, though, are really creeping up. And that's because credit card rates are among the highest that we've seen in decades and decades. So we are starting to see some weakness sort of filter in, particularly to those low and middle income workers, who are also seeing now slower wage gains than what we've had. And so you're starting to see it creep into certain areas of the market. And from the Fed's perspective, what they're going to worry about is that starting to deepen within that segment and then to widen out to other consumers as well.
Okay, so something to keep an eye on there, of course, when it comes to delinquencies and the consumers. But I want to broaden out and I want to talk about politics. I believe we're under 40 days to go until we get that U.S. presidential election. And we were having the conversation with Andrew Slimman at the top of the hour that you think about what the best outcome would be. And it's not necessarily who wins the top ticket, but it's about the down ballot races and whether or not we get a clean sweep or a divided government. His thinking was that basically division would be the best case here. How were you thinking?
Well, I would actually say the best case scenario is that we have certainty, because what the market dislikes more than anything is uncertainty. So if we're able to come out of that election in early November and actually know who's going to be not just in the White House, but in these other seats, that's going to be a good thing, because then we can sort of plot out the policy path a little bit more. And I think in generally, the market has really spoken, not so much whether they prefer a Democrat or Republican House or White House, but they have spoken in terms of liking a divided government. And so that's been a sort of consistent theme over, 100 years worth of data. So I don't think that's a terrible place to be if we do end up with a divided Congress.
What if we have a red sweep? I mean, what if we have Trump winning, the Republicans taking the Senate, tax cuts deepened, corporate taxes lowered, tariffs raised, mass deportations? What does that do to the inflation picture, the economy, the markets?
So it's all about sort of squaring that circle between what a candidate says they're going to do once they're in office and what they can actually do. In the scenario that you've painted, right, with a red sweep across, the assumption is that all of that would actually get passed. I actually think that even that's going to be a real stretch. It's going to be really hard to pass really aggressive tax rate cuts when you still have a lot of Republicans who are very fiscally minded, watching the deficit. So it's still going to be a give and take, even in a red sweep.
Kestra Investment CIO Kara Murphy, thank you so very much for your time today. Of course, very interesting moves in the market right now. Want to look at two things going on here. Of course, the S&P 500 hitting an intraday record in the U.S. Open. And remember, we have hit multiple records this year. You saw that strong data this morning. And we want to take a look at just what's moving the market as well. But it's not just the United States, as though Matt has been talking all week about the exuberance that has been here in the U.S. relative to everything else. Also taking a look at, of course, the NASDAQ Golden Dragon Index. You have seen it over 4 days jump up to the tune of almost 20%. 11% of those gains come today alone. Of course, this is a way that many U.S. investors as well gain access to Chinese equities here, particularly ADRs. And so the exuberance is coming all around.
You know Carol Master is going to be touting the Golden Dragon Index at the close. She's always so focused on those Chinese stocks. And obviously, it's a huge tailwind for stocks today. Plus, you have Micron coming back. Plus, you have Southwest coming back. They cratered also earlier this year. Those two, by the way, not nearly back to their all-time highs.
No, it's a good point that when you think about levels, not quite there. The direction of travel is interesting. Interesting, too, that China is a tailwind today when the rest of the week really hasn't been.
But still a lot of dispersion in the market. We're going to talk about some of that next, Katie. In top calls, coming up, Hershey's gets kissed with the downgrade from Jefferies. One of the few sadder stories in the market today that's full of exuberance. In top calls next, this is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
This is Bloomberg Open Interest. You're taking a look at the stock market right now, and the S&P 500 hit an intraday record, of course, giving back a little bit of its gains, but still up 0.6%. You can see across the board, we're looking at green today, from big tech to the small caps. We'll continue to keep an eye on that, but it's time now for our top calls. Some of the analyst action in focus this morning, and first up, Jefferies, not so sweet on Hershey's, downgrading the candy company to a sell. The firm says that chocolate sales, they've been weaker than other snacking categories in recent years. Next up, we have Bernstein raising Starbucks to a buy, also increasing its price target on the coffee giant. The firm cites market optimism since the appointment of new CEO Brian Niccol. And this is interesting because remember, 2 days ago, Starbucks was hit with a rare sell rating at Jefferies on caution that, quote, the CEO shakeup rally was overdone. And finally, we have Morgan Stanley double downgrading Sonos to a sell. The firm is highlighting backlash from users after Sonos redesigned its app, Shonali.
Another stock we're watching, of course, is Southwest, authorizing a new $2.5 billion stock buyback program and detailing plans to revamp customer-facing policies. It's trying to fend off an activist investor, and remember, it's been trying to do so for a while. Here with more details is Sid Phillip, who leads Bloomberg's global aviation team. Sid, you know, Katie made this great point before. You saw Southwest soaring to levels or at a margin here that you haven't seen since 2020, when you saw really like a vaccine here, a way to get us out of this global pandemic that had sent the stock plunging. The reaction you're seeing to a $2.5 billion buyback, does the exuberance justify what you saw back in 2020?
They have not just a buyback. I mean, they've announced a whole bunch of measures, including measures that could potentially raise revenue, and they also upgraded their forecast for revenue for the third quarter. So they've sort of put out a bunch of good news for the company, and that could potentially sort of show that they're looking at ways to shore up revenue and essentially increase profitability and sort of fend off the threat from the activist investor Elliott.
And I mean, how much of this, putting it into context, is just a case of very low expectations for Southwest? Because you look prior to today, through yesterday's close, the stock was basically flat on the year. The overall industry is up, what, 18% or so. So, I mean, how much of this is just, this is a stock that really needed some good news?
There is a large portion of that because, I mean, Southwest Airlines has underperformed its rivals, and that's in part because of the sort of struggle that the low-cost carriers in the U.S. have faced, as well as Southwest's own policies. I mean, they've been working on trying to upgrade their systems. They've talked about how they're going to move to assigned seating. They've also talked about how they're going to start increasing premium seating, and that's going to sort of bring in more revenue because, I mean, the other airlines have seen surging demand for their premium cabins, especially first and business class, and Southwest Airlines is a low-cost carrier, and so they don't have that available to them. So that's why they've sort of lagged the industry, and at the moment they're looking at ways that they can shore up profitability.
When you look back, Sid, at the biggest move they've made in March of this year, they cut capacity, absolutely destroyed the stock. In fact, the drawdown was more than 30% from its high to its low this year. Does that turn out to be a move that others are going to have to make as well, or is this company, does it have its own particular problems?
I mean, we've seen a lot of airlines pulling back on capacity. I mean, especially on the ultra low-cost carriers, we've seen a lot of them sort of try and pivot their business models. We've seen other CEOs talking about how the low-cost model in the U.S. isn't quite working. So there's a lot of industry issues at the moment, especially in the low-cost sector. We also, I mean, Southwest does have its own quirks as well, and so that's also been on display, especially as they fend off the activist who's demanded management change. They demanded the ouster of Bob Jordan, the CEO, as well as their chairman. So there's a lot of things going on with Southwest Airlines, and this could potentially be something that sort of takes the stock up because everyone's talking about how they have a plan to actually get their revenue going and profitability back on track.
All right, Sid, always appreciate your reporting. That is Sid Phillip talking about Southwest. Of course, shares currently up about 10% intraday. That is the biggest one-day gain since November 2020. Now, coming up, we'll speak about another stock that is absolutely soaring right now, Micron, up by nearly the most in nearly 13 years after giving a surprisingly strong sales forecast. Details next. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Let's get back to Micron, which is soaring after boosting its forecast on strong AI demand for its high bandwidth memory chips. Bloomberg Intelligence senior analyst Mandeep Singh is with us, and very good news. I keep looking at this and thinking, but this stock has gotten crushed this year. I mean, the drawdown from the high to the low is more than 40%. So it's kind of a bounce back, right?
It is, and look, 90 days back, the management didn't sound very confident about their opportunity, and this time around, they quantified HBM growing from $4 billion in 2023 to $25 billion in 2 years, 2025. And so just the confidence in terms of the end market exposures they have around PCs and smartphones rebounding and the HBM, that's what made the difference. And look, CapEx, they increased slightly, but that's all going towards adding HBM capacity, which is what the street wants to see.
So I am no expert in high bandwidth memory, to be fair, but what I do find fascinating is that they're sold out of this product, not through this year, but also through next year.
And locked in, so they can't really raise prices, right? They've already agreed prices.
Totally, which also, while that's great, to Matt's point, what would move the stock even further higher from here if they're already sold through next year?
I mean, look, they are exposed to different end markets. So HBM is one part of it. The traditional DRAM that goes into servers is also an add-on, and that's still the bulk of the business. The good part is they're not seeing any pricing pressure anywhere. I mean, look, last year, 2023, their gross margins were negative. So clearly there is that risk, pricing risk with memory. That's always the case. It's a cyclical industry, and you will see, supply catching up to demand. And when that happens, pricing comes down. They're saying it's not going to happen at least for the next 4 quarters.
And switching gears here, you were wearing some very cool glasses yesterday when we saw you. A special pair of Ray-Bans. Of course, we're talking about the Meta glasses that you had on. It's interesting. I mean, you have a note out saying that basically Meta's position in wearables, it's aided by these glasses. But then you think about Reality Labs, which, of course, the glasses fall under. Even though these glasses are very cool, and I think you can attest to that, that category is losing so much money.
It is, but now they have given us a proof point that all that investment has resulted in a product which consumers like. Actually, Ray-Bans, we think you will see a meaningful upside to unit shipments in Ray-Bans. And we're already seeing that. They keep saying they are supply constrained. So even if the monetization part AI with their own AI, we think that's a big advantage. The fact that they can deploy their own large language model on their own hardware, that's a seamless integration that Apple wants. Apple Intelligence doesn't involve using their own model.
Right.
They're using OpenAI's model. So that's where I think Meta really has a very strong case that they have that end-to-end integration when it comes to these Ray-Ban glasses.
So you'll go from losing your phone to losing your glasses, basically.
Exactly. Well, who doesn't lose glasses?
Also one step away from chips in your brain.
Well, although we can find them, right? If there's a chip in them.
That's true.
Then find
you can just think about them.
Yeah. Bloomberg Intelligence Senior Analyst Mandeep Singh, thank you so much for joining us. A lot of stuff to talk about in tech. Coming up next, Rock Creek's Alethea Doriwala explains why she's expecting a turning point for active management. This is Bloomberg.
Connection lost.
I generally believe I'm a much better CEO right after a vacation than I am before vacation.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, everyone. We almost made it. It is Friday Eve, and we got a market rally underway for you. The S&P up 0.6%. This would be the 42nd record high, in case we're all keeping track. Paul Sweeney's off today. Bailey Lipschultz sitting in for him. We have a busy show. Lots of news coming up over the next couple hours. Tom Orlik will be joining us from Bloomberg Economics on the latest moves out of China. Plus, Scott Stringer, former New York City comptroller, will be joining us on New York City Mayor Eric Adams, indicted after federal corruption probe. We'll be all over that story. Then you got OpenAI and Micron. We're going to head to Mandeep Singh, Bloomberg Intelligence senior tech analyst, to break that down. And Greg Jackson, CEO of Octopus Energy. This is a treat for you, Bailey.
Every time I co-host with you, Alex, we talk about energy or minerals or something that I don't understand.
None of this is surprising, but this is cool. They do energy stuff. They have a technology platform called Kraken. I mean, how can you not think that's cool? We'll break that down for you over the next hour. Let's kick it all off with John Tucker and a Bloomberg Business Flash. John.
All right, Alex and Bailey, we are being brought to you by IBKR. With the Interactive Brokers Forecast Trader, you can trade your views on key economic and climate indicators. Visit ibkr.com/forecast and get started today. Yeah, S&P 500 powering through its record close. The U.S. economy emerging from the pandemic in better shape than initially thought. The comprehensive annual update from the Bureau of Economic Analysis showing a 5.5% average inflation-adjusted increase in GDP from the second quarter of 2020 through 2023. So that's kind of cheering investors today. Best performing stock in the S&P 500 right now, Micron Technology. They reported after close yesterday, delivering a strong sales and profit forecast. Demand for artificial intelligence giving them a boost. Micron Technology shares right now, they are up 17%. Meantime, Evan Brown at UBS says we can expect another jumbo rate cut from the Federal Reserve.
More broadly from the Fed, I'm really looking for, how concerned are they about the dynamics in the labor market? I don't think it's about inflation that much for them anymore. Right. We think that the labor market's going to continue to weaken. They're going to have to go 50 again.
And applications for unemployment benefits falling to a 4-month low. The other piece of data we got today, S&P 500 right now 35 points higher, 57.57 on the index. Dow Jones Industrial average up 226 points. The NASDAQ 100 is up 219 points. That is a rise of 1.1%. Two-year yield right now up 4 basis points. Right now at 360. The 10-year yield is unchanged at 379. This is one of those emails I got earlier today about a Bloomberg story I should do. It's a legitimate story. JustEatTakeaway.com has partnered with sex toy maker Lovehoney, the latest move by the online delivery company to expand into non-food categories.
I sent him this article earlier in the day.
You didn't have to admit to that.
I didn't actually
what do you want me to do with this?
He was going to do it.
No, it's a publicly traded company.
Yeah, it's real. And you want to, move on from food. You could think maybe the margins are a bit better. I don't know. Actually,
for some people, there's an overlap there, but
that's true too. Yeah, there's a lot of ways to go with this conversation, but we're going to leave it there. But in some ways, this makes a lot of sense. All right, John T. Thanks very much. John Tucker joining us there. All right, let's get more of the market. Bailey doesn't know what to say, so we'll let that go.
Again,
let's get more in the market reaction here for you. Natalia Knežević joins us, Bloomberg Equities reporter. There is a lot on the move today. This is definitely more interesting than yesterday. What are you watching?
So first, let's talk about CarMax. The stock reversed earlier losses, but it was under pressure earlier today after it reported a 14.4% year-over-year decline in income for its auto finance unit. And the company blamed an increase in provision for loan losses. And also it highlighted that inventories are down 11%. For some analysts, this is an indication that the company is being more conservative. Overall, report was good. And again, some analysts are saying that now funding costs are moving down. This will be positive for consumers, and maybe there will be more demand for cars.
Yeah, CarMax, ticker KMX, up 3.5%. But Natalia, the story of the day, Micron, up 17% right now at one point, up the most since November 2011. What's going on?
Right. So it's a big relief, I think, for everyone who is watching this huge AI trade. Overall, the key takeaway, demand is outpacing supply. That allowed Micron to kind of be confident about pricing. It secured contracts not just for 2024, but for 2025 as well. And on top of that, we know that there are so many worries about personal computer segment, but this report shows that demand is picking up, and as a result, we see this more demand for chips. Overall, again, stock is up 30% year to date, and of course it outperforms the Nasdaq 100.
All right, and Natalia, last up, what are you watching?
Chinese stocks, of course, and all this excitement. So we heard from Chinese government again today. And in terms of things that we are watching, yes, of course, Chinese, US-listed Chinese stocks. Of course, Alex, this is also your area, mining, metals. We see companies like Freeport, McMoran are up today. And I will just give you some numbers, guys, in terms of flows that we saw in Chinese stocks. So hedge funds bought Chinese stocks by the most since March 2021. That was on Tuesday. In the options space, we saw that Goldman data shows that FXI, this is a Chinese ETF, saw an increase in open interest that we last saw more than a decade ago. And finally, in the ETF space, we also saw huge inflow in ETF called X Trackers, and that was the most since June 2024, almost 200 million of flows into those ETFs. So, and maybe it's not the end of the story.
No, I highly doubt that it is the end of the story. We're going to continue this conversation. Natalia, thanks a lot, Natalia Knežević, joining us, Bloomberg Equities reporter. So let's continue this story. Tom Orlik is Bloomberg Economics chief economist, and he joins us now. Now, Tom had lived in Beijing for a very long time. He was the chief China economics correspondent over at the Wall Street Journal. He also headed Bloomberg Economics coverage in China, Japan, and Korea. And now he joins us from D.C., but he has a long history of looking at these kind of interventions from the government as well as monetary authority. Hey, Tom, is this the end?
So I think we need to break it down into sort of two different problems. So the first problem is the cycle. And if we think about the cycle, well, growth was very weak, deflation was coming, markets were slumping, and this intervention by China's central bank and now the Politburo, well, it looks pretty decisive. The equity market has roared back higher. The Chinese yuan has strengthened. Bond yields have ticked up. And expectations for growth out to the end of 2024 and into 2025, well, they're a little bit stronger. So on the cycle, this is certainly a positive moment, maybe a decisive moment. The second set of issues, though, is around structure, right? And that's where we have to worry about the massive overhang of property supply, the shrinking workforce, the increasingly fractious relations with the United States. These are the factors which are going to be weighing on China's growth, not just in 2024 or 2025, but out into the next decade. And on those, well, nothing we've seen in the last few days really changes the picture.
Yeah, Tom, with that in mind, we're seeing a tremendous rally across assets, especially in China. Just looking at the Shanghai Composite, up 9%, more than 9% in the last 3 days. Does this have sticking power? It feels like in the past we've seen these moments where stimulus is kind of drummed up and China talks about injecting money into the economy, and then those moments are relatively fleeting.
So the last couple of years has seen what you might call a kind of steady drip of micro policy moves. The PBOC cuts interest rates by 10 basis points or 20 basis points. The PBOC frees up a bit more funds for China's banks to lend. The Ministry of Finance puts a bit more money in the pockets of local governments. What we've seen in the last few days is a kind of a package of more powerful measures rolled out at the same moment, and the Politburo, the 24 men who kind of call the shots on China's economy, coming out with some pretty sort of firm statements about how they want to turn the cycle round, halt the decline in property, give equities a boost, right? So if we think about markets, if we think about growth for the next few months, maybe even into early 2025, this is a pretty important move. If we think about those bigger structural problems, if we think about the millions and millions of empty homes in China, we think about the shrinking working age population, no, nothing which has happened so far is going to move the dial on those big structural problems.
And here's the question we've all been waiting for, right? When is China going to cut checks to people? I mean, they already mentioned that they were going to do it for their low incomes, just a one-off. But that's literally what needs to happen, no? So, like, when are they going to do that?
So it's a great question, Alex. I'm sure we're all familiar with the term pushing on a piece of string, right? At some point, there's just too much debt in the economy. And when you cut interest rates, well, because debt is already so high, no one rushes to borrow more, no one rushes to invest more, right? And I think that's almost where China is, right? Debt's really high, so rate cuts, they help a little bit, but there's certainly that pushing on a piece of string aspect to it. So if you really want to accelerate China's growth, what do you have to do? Well, the government has to open its checkbook and put money in households' pockets. Now, we've seen the Politburo say they're going to amp up fiscal stimulus. So it seems like the checkbook, the government wallet is starting to creak open. The question is, well, how much money are they going to put to work, and where are they going to put it to work? Is it going to be a kind of traditional infrastructure style stimulus? Let's build some more bridges. Or is it going to be the consumer stimulus? Let's put money in households' pockets so they can upgrade their home electronics, maybe switch to an electric vehicle.
All right, Tom, we appreciate that. Thank you very much. Tom Orlik, Bloomberg Economics chief economist, joining us on the China Latest. It was a bombshell that happened in the last 24 hours, and that is New York City Mayor Eric Adams indicted after federal corruption probe. There's video and pictures of officers raiding Gracie Mansion, where the mayor lives. It's something. It is definitely a moment here in New York political history. So we wanted to talk to Scott Stringer, former New York City comptroller, on all of this. Scott, the latest that we've heard is that Mayor Adams is going to fight this. He definitely doesn't look like he's resigning. What is your take on that?
Well, look, I think he should and must fight it. This is his life, and he has to have full focus on a very serious federal indictment. But that is what he has to do for himself. Unfortunately, you can't govern the city and fight the indictment, and that is why he should step aside for the good of the city. I presume no guilt or no innocence. That's for the courts to decide. But I do think we have to be laser focused on the city. Look, the business community in particular has invested billions of dollars in the financial capital of the world called New York City. We have citizens, middle-class people who are struggling to pay their rent, struggling to get their kids through school. The job of mayor is to be that person who works every single day laser-focused. That cannot happen anymore in an administration where not only is the mayor indicted, but almost the entire leadership team is under some indictment or federal investigation. So with great respect to the mayor, recognizing innocent until proven guilty, it is time to step aside. We've got to govern this town in a way that's never been governed before, and I think he's got to just step back.
And Scott, if he doesn't do that, what's your view on the timeline of how these events can unfold? Because I just think back to last November when the FBI agents raided the home of an Adams campaign fundraiser. That's really what kickstarted that, and that's 10 months in the rearview mirror.
Well, look, at the end of the day, that's what investigations are for. I mean, the federal government has obviously taken time to look at all of this. They're announcing charges probably as we speak. And my concern as a citizen, as a public school parent, as somebody who's managed the finances of the city for 8 years, this is a tender moment for New York. We have to send a signal internationally that we are open and ready for business. We cannot play the political game back and forth. We need strong leadership now. We need leadership in finance. We need leadership to actually get things done. Look, I love this city. This is a sad day for me, but I've seen corruption scandals over the years. I've fought corruption my entire life, and it's a very sad moment at this point that we have to be going through this.
So there's a couple of things to unpack to that with me. So as a parent of a child in public school, I totally hear you on that. In terms of a business or a CEO making an investment in New York City, I'm struggling to see how this really moves the needle, in that a lot of us are now desensitized to these kind of indictments and scandals, rightly or wrongly. When you have a former president also accused and convicted of crimes, everyone here is like, yeah, okay, and then let's move on. So is it really going to impact it in the way that maybe 20 years ago we would or should have?
Well, I'm not going to give up on the sensibilities of both the American public and certainly New York City residents. First of all, we New Yorkers, we get this stuff. We are savvy. We've seen it all. So I don't think this is going to sit well with the public. I don't think people are going to shrug their shoulders walking to work today saying, it doesn't matter. I don't think Trump's getting reelected, in part because he's had criminal conduct. I think people want stable leadership. I mean, let's talk about the public schools. We have kids who are still struggling with COVID. I see the difference between parents who have some resources and parents that don't. The whole public housing developments are collapsing. We're not building affordable housing fast enough. And look, the job of mayor is to reach out and get to those entrepreneurs, the tech entrepreneurs, the communities that we rely on to jumpstart and pump up our economy. We want business leaders to say, you know what? We want that old New York City compact back. We will attract the best and the brightest to our workforce, but the job of mayor is to provide open space, public space, safety in the streets, safety in the subways, a real mental health initiative to help with homelessness. But also, we got to make sure that rather than tout a robot called K5 to do policing, we actually need a policing strategy that's fair but strong, and we have to meet these challenges. This mayor cannot focus on it because rightfully he's got to focus on a major federal indictment, and I don't blame him for doing that at all.
All right, Scott, we appreciate it. Thank you very much for that insight. Scott Stringer, former New York City comptroller, joining us there. Again, we will keep you updated on any headlines as they cross, but New York City Mayor Eric Adams indicted after federal corruption probe. He has already said that he's been facing these lies for months, and some Democrats, as you just heard, also urging him to resign as he is seeking re-election next year. All right, in the market, we are still a rally underway. We're looking at the S&P up by a full half percentage point. Bailey, this could be number 42. Do you have like streamers and balloons ready?
Yeah, I have a like a box that I check every time, so I'm excited to hit 42.
Okay, fair enough. I mean, there are more record highs this year than how many years you've been alive.
Yeah, by 12. Like, but that my birthday's tomorrow, though, so we get closer.
It's Bloomberg.
older than Bailey?
There's a lot to unpack
As we
with
get
that.
ready.
Are they your
For his
lawn mowing
birthday?
shoes?
Wait, this is a birthday tomorrow, right?
yeah.
Are we saying how old we're turning or no?
31.
Oh, 31.
Yeah.
So you have 31-year-old sneakers.
Yeah.
I don't
A
understand.
31-year-old pair of jeans, too.
Are they Chucks? What kind of?
I mean, jeans, fine.
No,
but
they're
literally sneakers. fall
Rod
apart.
Lavers. The green, tennis shoes.
You know Rod Lavers?
No.
Sounds like a guy my dad played high school basketball with. You know Rod
That's
Lavers?
amazing.
Yeah.
I don't know what to say to that. I mean, eventually they fall apart. My daughter's lifespan of sneakers is
My
literally like
point
10
was,
days.
he's just such
He's
a
so
young pup.
Yes,
Look
young
at him.
pup. But we're all excited for him because he's got a house, he's got a wife, he's turning 31. It's very exciting. Okay, I'm Alex Steele alongside Bailey Lipschultz and John Tucker.
His whole life
this
ahead of him.
Is Bloomberg
Let's see if we can ruin it
Intelligence.
for him.
We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries worldwide. The news that broke yesterday is that OpenAI is going to transition from being a nonprofit organization to a for-profit company. I have no idea what that means, but the goal of the company was supposed to, quote, benefit humanity as a whole, unconstrained by a need to generate financial return. If that changes, what does that do to the actual company? Joining us now is Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst, joins us now. Okay, I don't get it. What does it mean?
Well, I mean, they've been looking to do that for a while in terms of becoming, a profitable company similar to other tech companies that are out there. And I guess we had hints all along because they never open sourced their model. They are the leaders when it comes to generative AI. And there are two approaches right now with companies keeping their model proprietary versus open source. And they are one of those who have kept it proprietary. So it's not a surprise that they wanted to convert to a profit structure, given all this has happened. I think the bigger thing here is the CTO, Mira Murati, leaving, and pretty much all the co-founders of the company leaving at this point, with Sam Altman being the only one there. So that's, to me, is the bigger news.
Capitalism strikes again. But real question, though. If it's valued around $150 billion, and you mentioned
to large language models, whether it's come down to safety issues or copyright issues, we don't know that level of transparency. And I think the fact that all the co-founders have left, clearly there is disagreement and tension, and we can only speculate from the outside, but it's never a good sign when, the core team that started the company, these are the technical guys who have left. So Sam Altman is the face of the company, he's the CEO, but these are the real technical guys who built the product. So, I mean, look, they have a big bench, and the company is much bigger now. The fact that we haven't heard a lot about GPT-5, that worries me a little bit, because when you are a company like OpenAI who's leading the charge, you want that product roadmap to be out there. You want to set expectations. When is the next version of the large language model coming out? And I think that's where there could be delays.
All right, Mandeep, really appreciate it. Thank you so much. Mandeep Singh joining us, Bloomberg Technology Senior Analyst for Bloomberg Intelligence. A couple breaking headlines here for you. Let's cover oil first. Chevron has agreed that Hess's CEO, John Hess, won't join the board in order to get a merger approval of Chevron and Hess. Remember, this other breaking news here. Fed Vice Chair for Supervision Michael Barr delivers in a speech that he says that the Fed is exploring liquidity rule tied to uninsured deposit. Now, that rule would address those constraints on hold-to-maturity assets, part of the issue that brought down SVB at the end of the day. You have an asset on your books, you're holding for safety, you're going to hold them till the end of the term, yet when rates move violently up or down, it really creates a disparity then in that asset price. You also have potential requirements that could complement some of the existing rules, exploring some large bank requirement on minimum liquidity. So many things happening. It's so exciting. Good thing Allison Williams is here. Bloomberg Intelligence Chief U.S. Banks Asset Manager person. She covers all of these things. Just in terms of Wells Fargo moving forward to lifting the cap, in your estimate, like how close is Wells Fargo to actually being able to lift their cap, their asset cap?
You know, it's tough to say. You know, certainly this has been unprecedented, right? I mean, this began with a fine in 2016. I think Wells Fargo initially thought it would be a few months. It's been several years. You know, one of the biggest things I think, one of the biggest changes I thought was, you know, they changed over the board. They brought in all new management. Charlie Scharf as the CEO. He was sort of the third CEO in a short time period, but almost fully turned over the board, brought in a lot of ex-JP Morgan people. And then it's just been sort of blocking and tackling since. And we've seen a number of the consent orders get resolved, but there still are a few more out there that they need to take care of.
Yeah, just looking at the Bloomberg News stories stands out. The cap's lifespan so far, JP Morgan has swelled 64% to more than $4 trillion of assets, meaning they've added almost an entire Wells Fargo to the balance sheet. What's the timeline for Wells Fargo to potentially catch up? Is that possible? How would that work out?
Yeah, I mean, to some extent, there was, you know, a lost opportunity, right? So I think the biggest, you know, the biggest hurt from the asset cap was during COVID when JP Morgan and Bank of America were able to add all these retail deposits, right? And Wells Fargo really could not participate because they did, but it was a lot more work, right? Because it wasn't the loan side of the balance sheet. It was really the deposit side of the balance sheet that was a constraint because they were growing so rapidly. And they did do things to try to manage their balance sheet in the most profitable way, you know, getting rid of things like non-operational deposits that are, you know, less profitable and less valuable long-term than core deposits. They have sold off businesses over time. So, I mean, but for banks such as Bank of America and JP Morgan, granted, some of those balances did go away over time, but they were able to retain at least, you know, some of those customers. And so I would say that's where sort of the big harm from the asset cap has come from. You know, if you fast forward to today, the balance sheet constraint is not as significant. They have started investing in businesses like card and trading where they're under index, so they are growing their businesses. So you know, if the cap was removed, that would certainly give them more flexibility in those businesses. But on the deposit point, that's really sort of a lost opportunity.
Yeah, Allison, thank you. You weren't booked on this, but you came in exactly the right time. So thanks so much. We really appreciate you, Allison Williams, Bloomberg Intelligence Senior Analyst for Global Banks and Asset Managers. Also, we are looking at New York City Mayor Eric Adams. His indictment is unsealed in court. We will bring you all the information as that crosses. This is Bloomberg.